Back? I think it's back. That was really weird. I thought M and K was halted, and then I noticed everything was halted. Okay, looks like we're back. Oh, did it really end the stream? Come on. That wasn't that much time, though. Ugh, yeah, it did. It ended it. That's so dumb. Usually you get like at least a minute or two. Lame. The internet did halt. Yeah, it's on a new stream, unfortunately. MNK 130% now. So you'll get 100 million bonus for filing bankruptcy. Whoa. It's a float on this thing. 11 million. MNK 140% there. Excuse me.
Like you guys said today, after going to be a good sign for a lot of these companies with significant ad exposure, but Alphabet is always the first one that comes to mind. So easing some of those concerns, and really strong report across the board from Alphabet. They pretty much beat on every single metric here. Their revenue did rise 7% year over year, which was more moderate than what we've typically seen from Alphabet, but coming in around 74.6 billion. Now their other segment revenue did rise 24% on the back of some really strong YouTube subs. So I think that's another key aspect of this business. Even outside of AI that's so strong, they said that their YouTube shorts have been performing very well. That is a very close competitor, if you could call it that, to say like a TikTok. But their operating income did rise 12% year over year to 22 billion. They reported 58 billion in that key advertising revenue, which was up about 3% from the year prior. The company did report falling ad sales in its past 2 consecutive quarters.
What already started?
Nice trend reversal we're finally seeing in this ad market. Their product momentum also appears relatively robust on the back of better than expected results in specifically their core search. And of course, large language models, including the Gemini launch and the Palm 2, showed an improved pace on the generative AI
gotta
side.
reset the likes, guys.
Also
Sorry.
100 basis points, even with some of this more moderate top line
That's
growth.
the biggest bummer about resetting the stream is the likes reset. Anyways, thanks guys for the support today. 12 o'clock. We've got 2 hours till FOMC and then 2.5 till Powell.
Towards the generative AI workload. So go figure that of the
3
50
likes
covering this name, 41 do lean buy. I actually think the promising thing about Alphabet into this report is it hadn't seen the same degree of love so many other names had, like a Meta or Amazon or even Microsoft. Now today, shares are 46% year to date, but this name had seen some tepid enthusiasm going into this report, which is perhaps why we're seeing this nice lift today. Shares up over 6.3%.
Jenny, sorry, Kevin's turn. Sorry, Jen. Jen, here's my question.
In case chilling out
when
now.
you look at digital ad spend, which is beginning to become a theme as we get through this, we can't just assume that everyone's going to be doing well with digital advertising, right? Because Snap's not doing so well, but are there going to be winners and losers here? Can we look for that, or should we just say digital advertising getting better, all these should go up, because Snap's not telling that story?
No way. I think right now with a more tightened digital ad market, that we're going to see these advertisers more selective about where those dollars go, which is exactly, to your point, why a name like Snap, I think, has fallen completely out of favor. I mean, you could just see that based on its chart over the last 3 years. So I think right now, advertisers are going to look for non-controversial, relatively stable areas in which they could advertise. So for that reason, Alphabet to me has always remained one of the clear winners. Pinterest is actually another surprising one that I think will fare well this quarter based on some stabilizing ad trends. Meta is so large, I think that works to their advantage, but some of these smaller players like Snap, I think are going to be hurt badly, and this is just the beginning of the pain.
Yeah, you always, I think a few months ago we were having this discussion about some of their search business getting taken away by Bing. I don't think that's happening.
Who uses Bing?
Maybe Oliver does. That would be the only guy that I would imagine uses Bing on a regular basis.
I Google everything.
Yeah.
I literally Google, how do I get to the bathroom from here? I Google that to get there.
Me too.
I Google everything.
There's a whole adverse camp of people that have Androids, they're on Bing, and they're drinking Pepsi.
Just remember, Jenny, never go to page 2 on Google. Never. Don't do it, Jenny. Don't go to page 2 ever.
The ads are almost filling up page 1 now.
Don't ever go to, Tom, don't do it. Don't go to page 2.
I don't know if I ever have. Now I kind of want to.
Good choice, Jenny. Don't ever go there.
All right. Thanks to Jenny Horn, markets correspondent here, breaking down the Google Alphabet earnings. But now let's bring in Nick Theodorakis, Financial Risk Management Director at TD Ameritrade. Nick, I wanted to kind of get your take here on the earnings first before we dip into a discussion about the Fed. But what was your takeaway here? You're in the risk side of the business, so with massive gains that we've seen in Microsoft, the optimism, even though they beat, you've got to nail everything in every quarter, right?
You do, and from an overall risk perspective, there's so many people that trade indices, right? And we know that, and it's just a nice investing tool, whether it's ETFs, indices, however you look at it. So, the sort of story so far is, overall beats are going, like stronger than expected,
Yeah.
80+% beats. You see two big companies last night, kind of mixed bag. Indices are broadly unchanged. So I think the current environment, we're hearing more about soft landing. I know we'll get into all this stuff, but the way that earnings are coming out, there's not that much of a surprise. When you think about earnings and surprises and ultimately that yielding volatility, we're not seeing that creep up. So I'm still kind of trying to look down the road and see what are the real vol catalysts here. And yeah, there's interesting stories and headlines we talk about, but they're not like, oh my goodness, this missed by so much. Oh wow, this beat by a ton. And you look at Snap, and they have these sort of 20% days, and they always have, right? But the big stable top 7, 8, 9, 10 companies, they're kind of in line. A little bit softer here, things come back. No major surprises. Vol seems to be correctly priced at the time.
I got a question for Nick. Do you guys in the risk department, do you see like our clients are leaning bearish in a name for earnings or bullish in a name for earnings, where you would say, oh, that's good for us, or we'd rather have it going, without getting specific, obviously. But do you guys see like, boy, there's a lot of people doing some
hedging maybe?
Yeah, right.
Yeah, there's three basic camps, right? There's people that have had a long-term position. I'd say that's sort of the majority that we see. And then they're trading around that, right? So maybe I'm worried I'm going to buy some puts, or I'm going to sell some calls going into earnings. Then there's sort of the tight directional play, right? Like I think it's going to pop, and I want a one-day move, right? Some of the trades we talk about in terms of earnings plays. And then there's sort of the contrarian view, right? You get a lot of folks, I think, on the calling in asking, oh, it's up so much, it has to go back the other way. And where we interestingly see that is on the future side, right? People invest in their stocks and then sort of take a contrarian bet or a hedge type bet on the future side of things. So lots of different ways to play these markets together, but certainly there's folks taking short-term shots. We all know that the zero DTE, right? Just the short-term options are so popular now.
Right.
But I think more I call it more responsibly. So you have an established position and you sort of trade around that, and plug for the trade desk, but you can always call in and talk about any of these strategies and sort of understand the risks and rewards in all of them.
I'm sure you guys have seen the growth in meme stocks again, and the taking shots maybe on occasion, but maybe some people are investing. But that's kind of scary for me when you get markets at 12-month highs and stuff like that. So I know that's coming to the conversation. But now let's pivot, Kevin. We've got the Fed meeting today. It's a big one. Of 25 basis point hikes already baked into
Pulte family invested
markets.
millions.
But now we're all going to sit there and ponder and dissect every word.
Is that a Pulte tweet?
Jerome Powell
Oh,
says.
spy little
Give me your
breakout
take
there.
here.
One final thought on the meme trade. AMC today, option volume, 327,000 options.
Yeah.
Good Lord.
Yep.
That's a meme. 327,000.
If you're buying an
So if
option,
you're a little-
it's risk defined. You can lose what you pay for that option, whether it's buying puts or buying calls.
Ready to
But
go long again.
Hopefully, people are staying
see some
conservative
kind of-
with that stuff.
Now, on to Jerome Powell.
Confirmation.
This is
We're
going
gonna
to
fill
be
this
interesting
gap.
because my personal feeling is
Did he
that
tweet?
Friday's year-over-year PCE number is very important for Jerome Powell's attitude going forward.
Do they have that number yet? I don't think they do.
No, I have
Fed
no
will-
idea.
yeah.
If they do, they don't say it.
Right.
They say it's embargoed and things like that. But I think Jerome Powell wants to be done. But
I think they all want to be done, but they're all saying they're not going to be done.
that's because their
they have
rhetoric
to.
moves markets,
Right.
and they want to stay working against inflation.
Sure.
They don't want to give it all clear,
Right.
because you see what happens with consumer confidence.
Yeah.
When you give the least a bit of, this market, I've always said it, it's a spoiled child.
Yeah.
If you give them a little bit, they run and grab everything, and I don't think Jerome Powell wants that. So I think he's going to be very consistent with his rhetoric, but then when the questions come,
I know,
and
Lords,
they
this is
see
great,
a
actually.
little color,
This is when you want to
that
be
may give the
buying.
markets hope. Like last time when he said, I don't think
But I guess you're not buying.
rates have been restrictive for long enough yet.
Yeah.
That's why he paused, I think.
This is what you
and
want.
A few presidents said that. Some of the members of the FOMC
Not going down.
stated that. But Nick, go ahead.
Well, we'll see.
It's good. Good barber
trend has
coating up
been
here.
The official statement is hawkish-ish, right?
Yes.
Hawkish, is that a
They
word?
usually stay on
Hawkish-ish.
point.
And then the commentary and the
Might
way
take
he
a long
answers
here in
the
this
questions
retest.
leans more dovish.
Well, that's because they're asking him the other side,
That's right.
Yeah.
So will that trend remain here or not? I think you look at the CME Fed Watch tool, guys, and 5 to 5.25 is the current target,
Nah.
and
I wait.
a year from now in June, right? June 24.
Yeah.
That's the highest probability is 5 1/4, 5 to 5 1/4.
Right.
So I think there's this interesting concept right now of like they're kind of micro dialing in the final couple of hikes, right? This
Right.
I mean, maybe this changes, right? The market's going to move.
Tough.
Ask him,
Good
are we
top
done?
going.
Are you done?
So if not, then we go up.
Top
one
broke
more.
out
There's two
there
more
with
hikes,
some
but,
volume.
the market's pricing the fact that we're going to be right here next year.
25%.
And I think, I'm looking for, is there pivots in this conversation where they can say, like, we're going to hold here for longer? Because you go back to all the CFOs out there in the world, regardless of what industry you're in, you just want stability, right? You want to know the shape of the curve, and it's going to sort of hang out here and not just take off or get crushed, right? You want to know, because you can invest around that, whatever the shape of the curve is. There's strategies around that. When it's so unknown, that's where the confusion comes from. And I think consumer confidence kind of tells us that yesterday. You know,
Teledoc hanging out up there.
We've seen in a couple of
2
years.
years,
And people are saying, okay, if we're stable here, we can handle this, right? We can handle a 6%
MNK
mortgage. We can
came
handle
down
it
a bit.
because you know how to budget for that. If you don't know how to budget for it because there's so much volatility in rates, that's hard. So I think that to me is the soft landing argument. If they can just keep it consistent for now and tell people we need to stay there and the market buys that, I think that's the argument for the soft landing.
Yeah, I think the market's comfortable with maybe a quarter basis point hike today and maybe one more before the end of the year.
That's how it seems.
It seems like that's the way the equities have moved so far in 2023, that they're almost done, right? And everybody's looking ahead. But Kev, if we get that inflationary aspect that continues to hang on as consumer spending, consumer confidence is up, wealth effect with the equity markets, home prices are up, even though new home sales were down a little bit. But it still seems like there's warning signals out there that inflation isn't going down to 2% anytime soon.
No, and here's why. Jerome Powell talks about lags, right? Lags of the tightening hitting the market. There's lags in the spending too.
Yeah.
They don't spend, $4.8 trillion that they okayed in 2022. That hits the market in increments as well. And so the spending is offsetting some of the rate hikes. So there's lags on both sides.
Yeah, it's going to be an interesting one. Hopefully he'll get some hardball questions today. I always like a hardball question because it gets him to stammer a little bit.
Are you done? Really easy one.
There's an easy one.
Is it safe?
We don't know. We're going to listen to the data. All right, guys, let's take a quick break here. When we come back, we're going to talk about another mega cap tech name that reports earnings after the close. That's Meta Platforms. It's rallied about 147% so far this year amid better than anticipated ad market share. Fast Market's coming right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim Trading from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait.
Fine, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
Fast Market here on the TD Ameritrade Network. We're talking more earnings. Meta Platforms reports after the close. Shares are up nearly 147% so far this year. Kevin, when you look at this, we've talked about it with Google Alphabet and some other names. You mentioned Snap not being able to monetize their users. Their users are growing. They just don't know how to monetize them. 2 billion users on the Meta platforms across all their the scope of all their platforms. But when you look at this stock, this is kind of the poster child for the fact that, hey, digital ad spend has not pulled back like a lot of people expected, and this is the go-to place, whether it's Instagram or Facebook or WhatsApp.
We are at the midpoint of the year of efficiency. So we got to see what, and Mark Zuckerberg, and we've talked about it a lot on this show. He learned how to be a real CEO.
Yeah.
He cut 11,000 jobs, then he cut 10,000 more, and every time he cuts jobs or makes the place more efficient, the stock goes up.
Right.
So I think, listen, still, Tom, that being said, in the first quarter of 2023, operating income down 15%, net income down 24%. So the numbers are off their lows. The stock has made an incredible run, but they're still not at their peak. However, they are an enormous winner if digital ad spend starts to pick up. Because why? Because they target, you get a hit rate on the numbers, on the advertising that you do. It's really direct and specific. And so, yeah, they're always going to be a favorite. And Threads, we'll see. It went to 100 million. Now it sounds like it's about 13 million. So the numbers are all over the board, but they will compete against Twitter one way or another. They'll compete. I don't know if they'll become a real competitor, but like I said, they did it with Reels and Snap, and so listen. I think they're a real player. He likes to imitate other things and do them.
Yep.
So I think he'll compete, absolutely.
Yeah, and the growth is there just because I misspoke earlier. Facebook monthly active users were nearly 3 billion. Meta platforms across all their platforms, 3.02 billion on average for March of 2023. That's a 5% year-over-year increase there. So they've got the eyeballs on their platforms, Nick, and as much as maybe some some companies don't want to advertise on them, that's where the eyeballs are on their platform. So they almost are forced to. And as the digital ad market tightens up a little bit, you have to go to one of the leaders that has all the eyeballs, right?
Yeah, and the reason, and you'll see in my example trade, I've kind of shaded it to the upside a little bit here. Google's and Meta aren't a great comparison, right, in general, but just because there's so many different business units at Google. But 7.66 billion in YouTube ad revenue last night they announced, blew it out of the water. And that portion of the platform similar. You got people looking at a screen, right? It's not a search-based function, and they killed it. And I think that what you're going to see here, and kind of pull Snap into this as well, down 20%. Like, if you only have so much of a budget to spend, right? And budgets are tight around the world right now.
And you're pulling back on your spend.
And you're pulling back, right? You have to allocate that to where you want to allocate that to where the most eyes are. So you're thinking, it's sort of like the top 5 are getting, have this ability, I think, in this environment to pull away. We saw that a little bit from Google last night and how strong those numbers were. You have to think that Meta is in that same type of conversation, right? That if you're going to spend, if you have $1 to spend, you're going to allocate it more there as opposed to spreading it evenly with less platforms. I also think that with this competition with Twitter, right, there's a possibility that because it's so unknown, you could see even less allocation there than normal just because it's been so turbulent, the rebranding and all the kind of controversy there. They're not a huge ad revenue company anyways, but I think you could see people pulling back there. You're just not, so where else are you going to put your money, I think, is sort of the question. So,
but the biggest loser, guys, linear TV.
Yeah.
Those numbers will keep going down and they'll dip and they won't come back. Right. Linear TV, did you see the whispers from Disney about ESPN? Yeah. And they're starting to lean towards more streaming there. Yeah. Linear TV is going the way of the dodo bird. Slowly but surely.
Well, and Google's, I mean, I know we're talking about it here, but Google's leaned into that, right?
Right.
Training camp starts today, guys. I mean, this football's back, right? Like, so
Oh, listen to the Bills fan. Finally, he has a quarterback.
Google's got the NFL rights, right? I mean,
yeah.
So I mean, think about these big franchises. It's a big deal.
Yeah, and Apple's trying to get more and more into the sports angle of it.
That's because live TV is so popular, and football is so incredibly popular.
If you combine that on-demand streaming with the good live content, that's tough to compete with. I think Google's going down that path. So, but Meta attracts so many users, right? I think again, you just go back to the top, 4 or 5 kind of companies in these spaces just get bigger and bigger. Then you throw on, the cloud components of the Googles, Amazons tomorrow. Obviously,
I got some puts there also.
But think about user base and all of this. If ad spending comes back just a little bit,
stepped away, waited a little too long, missed the entry.
Their
well.
population is just absolutely massive.
Fantasy football has turned every game into its own entertainment movie, right?
Amazon's earnings next week, just for to clarify, next week on the 3rd. But we've got Meta tonight. Nick, you've got an example trade for us. Option market's pricing in, a pretty hefty move of over $25 either way in this one, so implied volatility is elevated.
Yeah, so the last few times we've talked earnings plays I've been on, we've gone out further in time, but there's a pretty decent vol here in these 2-day options, almost 150, which I think is a pretty interesting number. It's a little bit elevated from the historical norms, about a $27, $28 move priced in. So we're looking here at a weekly trade, and I've shaded it just a little bit to the upside based on the strike positioning. So we're selling the 280 puts to buy the 275 puts on the downside, and then the 322.5, 327.5 call spread. It's about $2.60 right now. So you're collecting more than half of the width of the strikes, and the reason that's the case is because it's a fairly tight spread. You put it on the Analyze tab and look, a 10% move either way puts you just outside of the range. But if you look at Google, you look at some of the stocks that have reported so far, we haven't seen these massive blowout moves. Things have been kind of in line. So you can get a 5-6% move here and still be within the range, and you've only got 2 days to weather that storm. 318, I think, was the recent high. So this pushes it just above that and allows it some room to run to the upside. So kind of playing the trend, but a little bit tighter spread, collecting more, because some of these vols, as we've seen the reports come out so far, have underperformed a little bit.
Yeah, it's pulled back over 7% from those that yearly intraday high, just above 318. Let's break down this example trade here. Short iron condor in the July 28th weekly series, selling the 322.5 strike call, buying the 327.5 strike call, and then selling the 280 put, buying the 275 put, $5 wide. On the wings of this butterfly, collecting a 260 credit. That means you got $240 in risk outside of 275 on the downside and 327.5 on the upside. Here, Kevin, you got a pretty good risk-reward ratio on this trade. It's only 2 days till expiration. Your thoughts?
If you notice what Nick did, he went a little outside the $25 move on the upside, a little bit inside it on the put side. How do I know? Look at the delta. The delta will tell you which way this is leaning, if it's leaning anyway. So yeah, he's got plenty of room on the upside, slightly higher than the latest highs. So this is a spread that Nick's right. Some of the moves have been inside the range so far. The market's pricing in bigger moves than are actually happening.
Yeah, and you look at Microsoft as a perfect example. When it opened up, it was only down about 2.5%, 3%. So, yeah, this takes advantage of a collapse in implied volatility tomorrow, which historically we see. But definitely a neutral strategy, range bound, but with a little kicker to the upside, give you a little bit more room. You do have some assignment risk on those short options going into expiration in 2 days also. All right, thanks to Nick Theodorakis, Financial Risk Management Director at TD Ameritrade. But coming up after the break,
to get the futures up there.
Be joined by Andy Swan.
Shorting the futures, I missed it. Go on.
Chipotle, which is
Wait
just
for
off all-time high
FOMC.
ahead of their quarterly report after the close. Stick around.
Tupperware's up 30. GME bounced there a bit. Tupperware breaking out. If it rejects this high, 182. Let's buy back down to VWAP. Maybe 500Ks on Tupperware? No, I didn't see that. Before any of this, I'm assuming. That's awesome. Remember how much he invested? I remember us talking about Tupperware. When was it? I came up with barbecue for some reason. There's some speculation with Tupperware and barbecue somehow. I think it even pumped. I don't know. I don't see it on the chart though. Value investing. Awesome. Yeah, I mean, that's how you make big gainers. Find imbalances in the market, right? What GME was. I don't know if Tupperware is that or not. I mean, squeezing at this point, but I mean, they were talking about chapter 11. So yeah, if it's not, then it's probably good value. Yeah, it's great value. What the heck? They're still making money? When was that? When did barbecue trade this? Was it here? It pumped somewhere, I think, where it wasn't that long ago. What was that? Yeah, maybe some shares and some short calls would be a nice play on here. That IV is awesome. See if it rejects here. I could be down for a long position on top. I don't know, I feel like when I looked at it before, maybe it was another company I'm thinking of. Who doesn't have Tupperware in their kitchen? Simple as that. You're profound. Yeah, I am sick. Just like a weird cough. COVID cough or something. It's not bad, I just... Yeah. And my kids all had it for like a month. It lasted a long time. We thought it just affected kids. Because we'd like get it for so long. It's not bad though, but yeah. Down a couple notes. Trace, you want to reset in a 20-year bull market? Sorry, man. You're actually at the end of that potentially if you're getting a reset. And you'll have to wait another... who knows how long. You just are in the 20-year bull market. Zoom out on the SPY. It's not even a bull market, it's a money printing market. We haven't had a natural bull market since probably before the 70s.
They're talking about the fresh menu items. They're talking about this new chicken dish that they have. You know, the only thing that's kind of been a bump in the road, you can see on the happiness, the consumer happiness graph that we have for Chipotle here, a big downtick here in the last couple of weeks. Well, really, that's all because apparently a store manager in Florida was...
No, I think the market will dump too. You're wanting the market to dump so you can have a 20-year bull market. It doesn't happen that fast. You're at the end of a 20-year bull market that took whatever 20 years to get there of range bound.
And that'll get cleaned up in the data shortly. But kind of a fun anecdote that's the only negative thing that's really come out about Chipotle in over a year.
Yeah, that's surprising. But at the same time, Andy, the more that they relied on delivery, I think that's a big thing. Like,
Afternoon,
I
Emperor.
don't Chipotle delivered anymore just because it's not as good as when you go into the store.
No, you've got to get it.
Oh, just watching the charts.
Right. Yes, I agree with that completely.
So, Andy, with the
got MNK making crazy moves today, 150%. Tupperware is doing stuff, and SPY's just making ranges before FOMC.
Because we've seen stocks that have
Tup's at a double top here.
Falter sometimes, even though pretty decent report.
Maybe make a handle.
Yeah, officially we're neutral on this. I think one of the ways to play this may be take a little bit of a shot that if it does get into new high territory, it could
I think
really
I would like
break
some
out.
shares
I think
and
we did that in a risk-defined
writing some
way.
calls on Tupperware.
That's a smart play. I certainly wouldn't be betting against the stock. I'm not sure I would just want to own shares here because, like you said, it's pretty high relative to range, but it has consolidated for a little while, and if it does get that move higher, I think it could be fairly significant.
All right, neutral on this. Great stuff.
BBIG coming back up a bit.
Data, appreciate it.
Thank you.
VWAP at that
That's Andy Swan, co-founder
$4.10.
breaking down the data for us on Chipotle. You know what, Kevin? We always talk about scale with brand names. They're not even close to being at scale yet, but they're going to be eventually because the model works at this point. We got that other one that just came out, IPO'd.
Depends on your plan of the days. I entered and closed today, actually. I entered here on this double bottom, and I closed once it broke. So,
my son.
I'm waiting till I want to wait till it breaks this trend line. Downward trend.
I don't always eat there, but it seems like I buy a lot of Chipotle in my life. But anyway, like I said, I think the growth prospects here, what they're doing with franchises, Brian Nickel he does an amazing job. And so I know I can see the chart. I know it's near an all-time high, but the story is just too good. Unless they come in with some real big softness somewhere.
Maybe foot traffic pulled back or something.
And that's why you trade with risk definition. But boy, I'll tell you, the story is just very positive.
Okay, so first things first, when we talk about this before we get into your example trade.
Short on MNK would probably be a good play right now.
We always say it.
Catch a downside on this.
Maybe some of the lowest we've ever seen.
Yeah,
right?
low price.
People ask, why is this trading $2,000? Look at the amount of outstanding shares. Right. It's very low.
Right. I can short this thing.
You got to understand that means this can move if it gets some significant news. Now, I wanted to do something a little bit different, kind of a lesson, but kind
I can't get margin on it, so I can't short it.
So I did something in the butterfly.
Otherwise, that would have been nice.
But I also tied
Buys coming down here.
in there. What did I do, Tom? I bought
so far, my strangle straddle, whatever it is
2075.
Working pretty neutral, which is nice.
A little bit lower implied volatility than the earnings.
But I do have one more put than call.
Else I did to make my butterfly, I sold into the earnings week.
And
I
I'm
sold
further out of the money, I think, on my calls.
2100 calls, bought one of the 21.5.
Yeah, I am.
So it's a little pricey because everything in Chipotle is pricey. But think about this.
Yeah, I'm weighted to the put side
if you don't
on
get
accident.
A hit on this tomorrow, right, with my
Hey,
diagonal
CDB.
butterfly, I call it, you could roll
Hot
those
tea.
into
Yeah, I should drink
next
some
week
hot
and
tea.
make it a normal butterfly into next week and chip away more at that. But
Like
if
a
you do
honey
get it,
gur.
remember, this is, you've got a week of
Apple cider
time
vinegar,
on your
honey,
long call. That's why
lemon.
it looks a little expensive, but it'll hold.
Look at that
value
inverse head and
as it gets
shoulders
higher
right there,
because of
though.
that. You've got a week between the long and the shorts.
Yeah, and you mentioned this thing has the potential to move. The option market's pricing in about $121 move either way.
Oh, Chicago's talking about
So
aliens.
you got to keep that in mind. But let's break down Kevin's trade here. It's butterfly with a diagonal component to it here. Buying one of the August 4th weekly 2075 call, and then against that, in the near-term option, the July 28th weeklies that expire in just 2 days.
I picked up some barbecue
Two of the
today, though.
2100
Ace.
strike calls and buy one of the 2105 strike calls on this one. You're paying roughly about a $15.20 debit on it. There's your
Cube
risk,
floating inside a bubble.
$1,520 per spread on this one, but you see the break even there on the risk profile. It's just about 1950, just below 1950 on the downside.
We took some pictures
on
of,
this one
I
because
think
you
they were
are selling
satellites
that
the other
2x1, 2100, 2105.
Never seen satellites that close,
call
though.
vertical with an
And they were
extra
blue.
call in there.
Usually they're just
on
white.
this one. Now you've got 9 days till expiration on your long option. And
just share that on
you've got some
Discord.
assignment risk on 2 of those short 2100 calls.
The alien freaks would
that
love it.
expire in just 2 days, so keep that in mind. And
Tom,
here,
look at the theta.
yeah,
The theoretical theta, about $1,300
yeah,
a day in
On
theta.
that
I'm
one, yeah,
respecting
because
that,
we've
right?
got two
Right
So
shoulder, the
front
inverse.
expiration.
yes, front expiration with that extra.
I'm planning on just holding these calls and
call on
puts
the
till after
2100
FOMC.
strike, on that
Hopefully
one.
dropping them off.
Kevin, the apex of profitability, of course, is at or near that 2100 strike. So even if the stock goes up, you're going to be profitable. And then if it continues to just rip through everything, Kevin, you're still profitable even above that 2105 strike also. But a good look at a strategy that you just don't want it to go down below that break even there, because that's where you've got risk on this
I'm
particular
a little
trade.
sick.
But definitely just
Told you
slightly
guys.
bullish on this, not like
Getting
overly
sick, you just couldn't hear
bullish,
it yet.
but, yeah, you want it to go to 2100 on that over the next couple days. All right. A good look at that customized option strategy, 3 legs on that. You got some transaction costs, no commissions. But coming up after the break, we're going to take a look at ServiceNow, which has rallied about 50% so far this year ahead of their earnings after the close. This is one to watch, especially with the AI discussion going on.
I just shared it in media on Discord. And tell me what you guys think. I should have orange juice too. I shouldn't have had that. Orange juice is so good though. 6 calls for all the money? Maybe. I mean, you're looking bearish. I've got 443 puts on SPY, and then 457 calls. I don't know why I got calls so far out of the money. That I'll dump on FOMC volatility. Like to hopefully I can have a couple that are free left over from when Powell talks. But I don't know, I don't have many. That's Starlink. Yeah, I know we've seen Starlink up there, but these were so close together. I've never seen them that close. It's kind of hard to tell in those pictures because they're streaking. They weren't streaking, they were just dots, of course. There were probably 20 of them. Like I've seen them. We've seen them where it's been like maybe 10, but they're spaced out way more than that. You can still tell they're in, you know, like a formation or whatever, or a trajectory that's on the same path. Maybe they just, I don't know. I think maybe they just got launched or something, but it didn't make any sense. So I'm gonna say they're aliens. UFO whistleblower. It's not a whistleblower unless she is an alien. There's my UFOs. It's about 30 blue lights in a line in the sky. Actually, I might go look for a long here on the futures. Looking at how it's making that nice right shoulder, if it can hold it. Got about an hour and 15. Yeah, hour and 15 till FOMC. Barbecue's up 3.9, 31, 39. Starting to round out this bottom, I think. Dish is down 6.8. BBIG down 8.9. Teladoc up 25. Groupon's up 10, GPS up 7. Oh, top broke it. Top broke that high. Wow. Now you've got a gap fill potential on this one. $2.40. Resistance here at $2.24. Where are we at? See if it's a legit break. Needs to find that as support now. Buy's coming down more. Yeah, you've got 42% on top order. Two more profitable quarters. Well, they were, let's see, they weren't profitable last quarter, right? So, gotta be, I think, so many in a row. Is it 2 in a row? So, 2 from here. Teladoc finally looking like it wants to come down to VWAP. Could just sell these calls. I should. I will. I am. Yeah, I sold my Teladoc calls. I might get back into something. We'll see. On a 25% day, it doesn't make much sense not to sell. Sell some kind of exposure. Buy's coming down more. I'm surprised the reaction on Teladoc from that earnings at this I feel like this must be insider buying. Wasn't that much of a beat. If you notice, a lot of the price action been today. It wasn't from the gap, from earnings. So I think the lockout period for insiders is right after earnings. Once that's public, they can buy. We'll see if there's any filings on Teladoc for insiders buying. I don't know if you guys track stuff that specifically. I know some people just watch that stuff. Let me know on Teladoc if you see anything. I know there's some links on our Discord for good stuff. Dish coming back down to the lows. What caused BBIG to move up? Ace. I honestly don't even know the cows for the up move. So, I'm not sure. But could still be good. Just wait for it to find support somewhere. Maybe $3.60. Maybe where it's at right now, the $4 range. Could be it. Wait for a bit of the upward momentum to grab it. Dish dip. Yeah, this is the worst reaction to bullish news ever. I averaged into yesterday, maybe today. Yeah, it was yesterday. Cash secured puts on it, and they're way up today. The value of them came down because it was so pumped yesterday. I think there was some IB crush for whatever reason. Maybe not. You're just having a ton of people selling off. They just dropped last few earnings. When are their earnings? They have been reporting earnings. That's part of the problem with this one. I think that's what I read. They got was it BBIG that had CC was giving them warnings because they weren't reporting? Some company I was reading about recently. I thought it was this one. I don't know. Where are the earnings on this chart? Why there's only 2 earnings here and none here? Maybe that's just Weeble. We've been back, Guts. We've been back. Eyes coming down here. Getting rid of this thing. I'm glad I'm heavier on the put side so far.
But buying one of the 580 puts, selling one of the 560 puts, selling one of the 540 puts, and then wrapping it all up by buying one of the 535 puts. So this is a put condor to the downside. You're paying roughly a debit of $8.
I'm getting reprimanded by deep value investing again.
This one, but your break even, Kevin, 572 to the downside on here.
It's up, did. It retested the breakout.
Share price on this. So what's your thoughts here on the the put condor, if you think this thing's going to grind a little bit lower, it doesn't need to go down massively.
Yeah, this is a different take on in the condor family, right? This is the difference between this and an iron condor. This is all puts, right? And so it's
yeah,
it's a range
made the
that you're on,
breakout,
and that's
retested.
between that 560 put and that 540 put. That's where the spread
I've got way too many
maxes
trades
out
I'm
up there.
dealing
And
with right now to mess with
still,
Tub,
because
but I
you've
do
got
like
a
it.
$20
I definitely like it for
and
that
a
gap
$5
fill.
put vertical, you're still insulated from any
2270s kind of resistance, and then gap fill up at 24.
540, 535 put vertical if you get a big move down, but you see your landing area there.
Yeah, looks good. I like it. Long term, maybe. I don't know. I want to see some.
Like the setup.
Do some DD on this thing. See what people are saying.
You know what? You're paying $8. There is risk on this trade, but you've got a nice wide landing range. The option market's pricing about a plus or minus $31 move in the shares, so it's a high-priced stock. But then even below that 535 strike, it's nearly a double on this one, Kevin, as far as profitability on this one.
I love the high IV there too.
We look at the put butterfly. That's unbalanced. That's kind of got.
I'm surprised I haven't written more contracts, more strikes.
Specific way, but this is definitely playing for a muted move to the downside. But you've got that extra.
There you go.
This one, it's not a pure earnings play on here, but you definitely want some downside movement in service now. All right, Kev, that's going to do it for you and I today here on Fast Market. But stick around right here on the network. Next Gen Investing's coming up.
Geez, this thing really sold off all the way into COVID. This bump it had from COVID. $1 to $38. Look at this stock. What was all the talk about them going bankrupt and what's all that about? Were they late on filing the 10K? Non-compliance listing notice. Six, 7. Yeah, BBIG did have a reverse split. Back here. 4, 6. So far, serious problems besides needing an extension. Yeah, an extension to file their 10K. I think that's kind of where it started. Top four issues: going concern warning. Hires advisor to shore up liquidity. That was 4-7. Delisting risk, and then going concern warning. I don't know why. Must have a lot of debt or something. I don't know what happened back here. I mean, long term, it might still be a great deal. Only at $2. Historical lows. You know, this is close to its all-time lows. barbacoating plus 3.2%. BBIG down 8.9. Fine, finding a bottom here. Could drop off my puts. I don't know what to do. I'll just hold. Because if these do like 1,000%, it's worth it to have the insurance to have protection the other way. All right, we've got 1 hour.
You guys have to say about that one, because it's been distressed, obviously, and yeah,
High, finding support here, back where it was. Tupperware, going back down to retest that breakout.
We got to kick things off with the movers of the day. The first two that we'll go through, of course, Microsoft, Alphabet. Let's start with Microsoft. This one's to the downside, and un-Microsoft-like. As the day has rolled on, as the day rolls on,
as the calls expire worthless.
It only got worse.
Yeah, right. I think that we're sort of digesting a lot of these major numbers here. Shares are down 4.5%. So actually, I mean, all things, relatively speaking, it's not necessarily making a monstrous move to the downside, but sales were up 10% on a constant currency basis, reaching $56 billion for the quarter. Adjusted earnings did rise 20% year over year to $2.69. Azure growth specifically
Kimmy glasses.
27% higher versus the
Full port
46%
spy calls.
levels of growth they saw just a year ago, driven by this overall consumption slowdown. Now, guiding for their first quarter, they see Azure outlook falling between 25 and 26% growth. Also in terms of constant currency, with signs of a bottom nearing for some of these cloud infrastructure growth rates, which is something so many companies, I believe, are hoping for with this quarter. They do remain optimistic that cloud gains for 2024 will be likely above that consensus at 25%. Cloud gross margins also did improve 300 basis points to 43% on some of these lower sales and marketing costs, which was the main driver of their overall operating growth. So this report was not as bad as I'd say the headlines perhaps are making you see, but we were just seeing So much enthusiasm
An
around
RSI divergence
AI,
on the
and of course
5-minute
their
there on Dish.
investment in OpenAI
If it climbs back up to VWAP.
I think that with some of these names, it's going to be typical to see some degree of a reversal, given the fact that they're all up like 40% on the year. Microsoft's still up around 40% this year, even with today's weakness.
Seemingly one word made all the difference. The word gradual when describing the impact that AI was going to have on actually dollars and cents for the company and that ramp up over time. Well, the stock didn't gradually ramp up. This is a point Oliver made this morning on Morning Trade Live that I thought was well put. We didn't watch this stock set new all-time highs for gradual gains. They were basically looking for expedient dollar and cents right now. Something like NVIDIA was actually able to show us in their most recent earnings announcement. I know we're not going to hear from them for a few more weeks, but that was a company that saw massive inflows of orders, massive impact to its bottom line right away from this AI boom. We're not seeing that necessarily from Microsoft. So fascinating to watch. We'll keep our eyes on that. Of course, this is, in my mind, this is the mover of the session with the stock down almost 5%. And being the second biggest company by market cap, it's going to be something to watch. Next one in its own right is doing its best to undo.
Can you imagine if
in Microsoft
if they pause and they don't hike this quarter or this hike,
I mean,
this
they pretty much
FOMC?
hit on all key cylinders here that were really across the board.
This call's going to be deep in the money.
But today they reported revenue that was up 7%. That was a modest growth year over year, but their other segment rose 24% on the back of strong YouTube subscriptions. This was a pretty steep rise from the 9%.
If they raise by 50 basis points,
their
puts will be deep in the money.
came in around $22 billion. That was up 12% year over year.
Probably going to be what we're expecting though. Quarter point.
$58 billion in advertising revenue, up 3%
Quarter
from a year ago. Now, this is something that's, I think, so important to investors and also the general ad space, which has been beaten down so significantly. For example, Alphabet had seen falling ad sales in the past 2 consecutive quarters. This was finally signs of growth again. So we'll have to see if then Meta today, when they release, can follow suit. But we do know that not all players in this ad space are created equal. Now, product momentum for Alphabet does appear more robust on the back of better than expected core search results. And have to mention this, their large language models, including the Gemini launch and their Palm 2, did show improved pace on the generative AI side. Operating margins did expand 100 basis points, even with some more moderate top-line growth. So again, really strong report. No wonder we are seeing shares up about 6% on the session, actually coming off of their intraday high a little bit earlier, but still touching these new 52-week highs today, now up over 46% on the year.
You know, 2 deals in the mega cap tech space, I think, almost defined this sort of generation, and it was Meta buying Instagram and what that's become, and Alphabet, formerly known as Google, still the ticker, buying YouTube. I mean, what a success the acquisition of YouTube
I've seen the generative AI on Photoshop.
Integration and the ad model.
Hasn't that been on there for a while?
So much revenue for Alphabet, and so super impressive report. Stock responding accordingly as well. As it's not on its highs for the trade, but it's up there still. Really nice move today in the company formerly known as Google. Let's talk some earnings previews now, though. Southwest Airlines, first one here on our list. This is the one that benefited we shouldn't say benefit, weathered the storm the best during the COVID period, but as we've sort of watched things normalize and bounce back.
Your power version's like a year old, maybe.
Is standing most
I'm just kidding. You can get pretty up-to-date ones, I think.
Absolutely, and I would say Southwest was the best position from a lack of international and corporate travel because they are solely seen as more of a leisure travel play. So a high flyer in the pandemic.
The powdered version now has AI.
As far as their price activity this year, they have had their own set of scheduling concerns that have weighed on shares really throughout the year. They're still up 6% on year to date, but just looking nothing like United, American, Delta. But we'll finally hear from them in terms of their quarter. They're the last of those 4 to report. Second quarter.
So barbecue shares have been updating. 249%. B 1.4 million on iBorrow.
14% greater capacity. Earnings are expected around
they've been updating all day today.
$0.08 per share on on about 887 million in operating profit. That's a 13% margin, about 470 basis points lower than second quarter and 370 shy of their pre-pandemic 2019 levels. Labor expenses were also higher this quarter, which is expected to then, I would say, weigh, of course, on their top line growth. That has a major result of these accruals for these pilot contracts, which is something all of the major airlines have been grappling with, but we have seen names like Delta, United already close out some of those deals. American and Southwest still somewhat in limbo. Though their cost per available seat mile for before fuel may rise 7%. That's what's being expected from a lot of these analysts. That's versus last year. And still be up about 21%
never got into
from
Spotify.
pre-pandemic levels back in 2019. I always think it is important to compare not only to a year ago levels, but back to, when things were more normal back in those 2019 times, because these names have been absolutely rocked naturally by the influx and the changing trends in travel, frankly.
And with those changing trends, there's some thought to stabilization of fares, if not even outright weakening of fares for a company like Southwest, as more and more travelers are seeking, like you said, overseas vacations, or maybe some of their trips end up being more return to corporate travel, of which a company like Southwest maybe doesn't have as much exposure to, particularly the international front. So they have potentially weakening fares, which is going to impact how much revenue they're taking in. But then you mentioned cost of per available seat mile actually going up, driven largely by those higher wages. And so that's not the recipe for investors that are looking for outperformance in this name. That's the definition of squeezing margins, selling your service for less, but it costs you a little bit more to actually provide that service. So, of course, this is the story to watch with not only Southwest, not only airlines, but this entire earnings season. How are you managing costs, and how are your revenues hanging in there in those margins? Are they compressing? Are you able to control that compression through passing on those costs to your consumers? It's been mixed thus far, but excited. Obviously, we're going to explore the two pre-earnings names. The last one here is Crocs. This is like the one name that it's so ironic always to me. It seems like consumers almost buy these ironically, but it works.
It does work, I guess. Like when I see someone wearing tie-dye Crocs in public, I almost feel like they're mocking the shoes, but they still buy them, I guess. So I feel very, very mixed on Crocs. I think there's a day when I'm on a cruise wearing Crocs, and that could be like the worst day of my life, perhaps. But we are expecting to witness some year-over-year revenue growth in this to be
on a cruise wearing Crocs.
They are expecting to release their second quarter today after the closing bell. Estimates
it's fine, just clean range here.
A year ago as far as their earnings. Now we are seeing revenue pegged at about $1 billion, suggesting an improvement of 8% from the year ago.
Go long on the futures.
Second quarter 2023 sales are likely to have benefited from the continued strong consumer demand for their new clog and sandal designs, which has been driving some really positive results in the past few quarters. Brand strength, as well as new products and refined user experience, as well as marketing activities, have been pretty significant growth drivers for a name like Crocs. Additionally, the acquisition of Hey Dude, which was a privately owned brand specializing in these lightweight casual shoes, is expected to have contributed to growth now for the to-be-reported quarter. Now, I had to look up what Hey Dude shoes were, and it turns out Ben Lichtenstein owns several pairs, and not going to hate on Ben's fashion choices, but they are also not exactly the first thing that I'd be looking to buy in addition to Crocs. It's almost like where they specialize is, I guess, comfort and sustainability maybe over the actual aesthetic of the look of the shoes. Nonetheless, though, Alex, this name is up about 10% this year. It's down about 3% this week into this report, up 103% off of its low, though, but it's since fallen out of favor. This name was really, really strong at the beginning of this year. We've seen that momentum sort of fade here.
Every time we talk Crocs on this show, I always get motivated. I'm like, I'm buying some of these. I don't know if I'll ever need them or want them, but I feel like these are something you got to have in the closet. Next thing you know, I'm going to be at a Carvana at this point. So who knows? I'm getting sold by the B-roll there, but to this date, still never actually bought the Crocs, even though I think I've made the promise that I am going to buy them every time we've talked about this for years. So excited to talk these two names. You can't deny the really, really impressive performance over the years in a name like Crocs. So whether it's ironic, whether someone's truly a fan of wearing these shoes, or they do it as sort of a gag gift or a joke, Doesn't matter. I mean, Crocs doesn't care why you're buying their shoes. They just want you to buy them.
I don't care how many celebrities they get to endorse their shoes. If Justin Bieber's wearing them, I'm not buying these shoes. I think I have PTSD because they used to be really worn on pool decks, and I'm like, I cannot separate the two. But we'll be moving forward today with our two upvotes. Those being the earnings, the names that still have yet to report their earnings, that Crocs, as well as Southwest Airlines. We'll be looking more at the technicals in those names, as well as some example trades. Stick around. Next Gen Investing. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Nicola. Pretty choppy. But looks like it bounced on support there, Nicola, at $2.01. It's not a good setup right now. Unless you're trying to just scalp it or intraday, maybe. Kind of have this head and shoulders here too. I don't know. I don't like the setup yet. But if you're shorter term on it, the bounce on this level could have traded. See. This is coming down. Yeah, there's no way to set up that little inverse head and shoulders on the 5-minute, but let's see, where would the breakout be on here? Kind of where it's at, huh? Yeah, there's your kind of breakout line. So I have room to rally up to that, see if it rejects that. If it does, it's just still in a downtrend. US at QuantumScape, yeah.
Sign that the overall trend it could be shifting to the downside as well. Our long-term moving average, our 250 2-day EMA here in purple, was a bit of a foothold for price here. We were able to.
Oh yeah, it's this company. That's funny. I never put that together. These are the motors I'm trying to get for my dirt bikes.
The real body of today's candle, the distance between the open and the close, is completely encompassed.
That's
by the
so weird.
previous
For some
day's
reason,
real
I
body,
never
the distance
put
between
that
the open
together.
and the close. That's usually a sign of stall and trend. It could be a sign that
Get them for
perhaps
cars
this
too.
downward trend is starting
Yeah,
to
they're good
lose
motors.
A little bit of steam here. However, we've got the RSI to look at as well. Our measure of momentum here, we can see that we are long
Weird.
gone out of that overbought area when we were making those highs near the $39 mark. We shifted and we trended below that overbought area. At the same time, we were breaking through this trend line. So that was a bad sign for the bulls. That was a sign of you know, reversal there. A sign that the uptrend was broken and momentum was broken at the same time. Now today,
I don't even know about their batteries.
50 midline here. You know, kind of putting everything together. It's looking more bearish now than it was before, but not really outright bearish yet. Kind of like we've just lost our uptrend and we're trying to wait and figure out a direction to go from this.
Wait, is this the
point here.
same?
So looking a little bit closer,
Maybe it's a different
support
company.
and resistance, we can see that the trend line that we've formed here.
Oh, this is a different company.
That's pretty
Never mind.
close to our volume profile point of control. So around the $37 mark to the upside could be an area to watch. That would be perhaps a sign, especially if we were to get above those old highs near 37.50, that the uptrend is starting to resume here to the downside. Purple 250 2-day EMA near the 35.40 mark is a crucial area to hold today for support. Then we've got
Yeah, if you're day trading.
34.50 level, that was about where we saw some highs here during our rally. That was a point where price topped out before giving
Should be
back
day trading
some
MNK.
gains. And we've got our orange 63-day EMA near the
Look at this move.
$34 level.
24%.
Yeah, like you said, Rick, from an RSI perspective, and pretty much the momentum we've seen all year long has been trending downward, looking more bearish, especially when
40
you consider
minutes.
the fact that the rest of the names in its same group have been such strong performers, relatively speaking. So with that in mind now, for example, trade today, Alex, walk us through the name more bearish.
Barbecue might be a good day trade today. This thing could have a pop.
Yeah, what we're looking at here is a stock that is trading at a relatively lower stock price. We're talking the
It's
mid-30s.
not as straightforward of a day trade though.
Or a name that doesn't have a ton of implied volatility. So of course you can look at strategies in a really short-term expiration.
Look at that GME just pinballing back and forth in my lines.
Somewhat limited by the low premiums in those
Like I
options.
told
And
it
so I
to.
looked at something that's a little bit longer dated, but will likely still see a benefit if you get a move post earnings towards the strike. So we're looking at a more traditional put calendar here to the downside. Selling August, buying September. So not disregarding earnings, using earnings as a potential catalyst that could be beneficial for this strategy, but not entirely tied to this earnings event, if you will. So looking at the 32.5 put calendar, be about a 30-cent debit on the last check that I had seen. And so that means $30 in risk on this particular strategy. It's a bearish strategy because, well, the strikes that are selected are lower than the current share price in Southwest. The risk profile, if we took a look, of course, is sort of that mountaintop-like risk profile that we come to know with the calendar spread or any type of time spread where you have two option expirations at different dates, making up your strategy. And so best case scenario, move to the strikes. In this case, that's 32.5, but of course, this can be customized based off of the expirations that you select, but also the strikes that you select. So a more bullish version of this may involve calls. A more earnings-centric version of this may include two shorter dated option cycles. This is, of course, the August-September 32.5 put calendar, looking for a move, kind of grinding lower over the next 20 or so days towards that 32.5 mark.
And now to shift gears here and look at Crocs, which has also been somewhat lackluster, especially following its last earnings move when we saw shares fall as much as 16% post that earnings reaction. So that was pretty ugly. We've yet to really recover from there, Rick. This was a high flyer at the beginning of this year, but it seems like these earnings events are very volatile for Crocs.
The earnings move was almost as ugly as the shoes themselves here. And that was the way that the way that this chart really kind of begins here. We had this point where we topped out several times around 130. Then we broke above it into some yearly highs above the 151 level. Then we had that rather cruel drop there that we saw on earnings that was kind of a rug pull for everyone because it looked like things were rather promising heading into that event there. That's the kind of price action you typically would want to see, but it was not to be. And since then, we've struggled with that.
You can't sell barbecue, you get yelled at? What the heck?
Here. You can see this red dashed line where price
Who yells at you for selling barbecue?
Recently matches up with those old highs for the most part that we when we were forming that sideways range in the first quarter of the year. So now that we had this peak that we've fallen off from, there's kind of two different trend lines you could draw here. We've got this blue trend line going across the highs and sloping down. We've also got this white one starting with where the gap opened up. So trend lines are subjective. There can be more than one trend line on a chart that makes sense and is even valid. They can both be valid at the same time. So it was interesting to me that we've kind of got this
I want to get back into Teladoc.
here between our resistance.
Not today,
We've got a
but
steeper trend line and a more shallow trend line to think about here. So today we're also falling below the 121 level. That's where price topped out here. Previously, it was also where we had a small gap form here. Now we're falling below that level. We're falling below our 21-day exponential moving average. The moving averages themselves looking rather flat. Our slope is not very strong directionally. That's not really what you'd want to see in a trending environment.
All right,
here.
35
If
minutes.
You look at our trend lines too. Either
About to
way
get
you
exciting.
slice it, we're kind of in a triangular type pattern here. We've got a trend line going up across the lows, and either one you choose, we've got our two to pick from. They're both trending down across the highs, converging toward each other. So if you put that together, triangular pattern, flattening moving averages, and if you look down at our RSI, a momentum reading that's pretty much smack dab in the middle.
People.
Not exactly a picture of
You don't have to
a
tell
strong
them.
trend either way here. So that's what you'd want to be looking for then would probably be a breakout beyond either of those trend lines to either to the upside or the downside to break out of the doldrums that we've been in here.
Be the happy money
looking
secret.
At our support and
Sell
resistance
things.
more closely, around 118
We don't just
would be
elect
a
them.
point to hold. That'd be our orange 63-day EMA. If we were to fall lower, we've got this area to contend with. Our 252-day EMA and our lower trend line roughly on top of each other near the 108 level. Then we've got the point of our worst close near about the 104 mark. To the upside, we've got our trend lines, but really the important point to me looked like the 130 level. If we were to clear that area, 136.50 up here, that was the site of where our gap
Yes,
opened
shared
up.
lending,
That would be
absolutely.
the next real
Dink,
test
what
for
are you
bulls,
getting
I would say,
for
to the upside.
really AMC's to play with the share lending? What does your brokerage give you? Have you looked into it?
We could see that $130
I haven't talked to Fidelity and figured it out.
obviously if we see
Let me
some
ask him.
bullish momentum, but of course obviously have to keep in mind that 16% move lower.
I want to buy AMC just for that.
After its last earnings, so I think a lot of investors are sort of weary of that move we saw. But we will leave it there. Appreciate the technical breakdown as always, Rick Ducat, our chart master. So now trading this name, Alex, perhaps looking at a more optimistic trade to counter the bearish trade we looked at in Southwest. Walk us through what you're thinking.
Yeah, neutral to bullish strategy here. A little omnidirectional though. Skewed put butterfly below the market. Again, going out to the August expiration. Reduce some of the sting potentially out there from just solely this earnings event and
Up a little bit.
super short dated.
It is 50%. Is that standard across all brokerage, or is that?
In particular, was buying one of the 112 puts, selling two of the 110s, and then defining the risk by buying the 105 put. If this entire package was done for a 50-cent credit, it would coincide with a max profit of $250 if it perfectly pinned 110, a max risk or max loss potential of $250 if it was all in the money below 105. And these options went through assignment and exercise and offset for the worst case scenario. Or, of course, done for a credit, you can keep that credit if all these options expire worthless. But the break even at 107.5 is outside
FBKR
that
does.
market maker
Okay.
move. And
That's
this is a
different from
high
different
probability
brokerages, I
trade
imagine.
in the sense that there's no upside risk. It's done for a credit, so if the stock does move higher,
Yeah, you could
we'll
lend
stay
out
where
your
it
2
is
shares,
over the
Dink.
next 20 or
Make
so
like
days.
8 cents a year or
Simply
something.
just keep that credit. If it moves lower to that 110 mark, you can see where that added kicker is from that long debit spread component of this, in which the max profit swells to $250. But most importantly, it moves that break even down. So just selling a 112 or 110, short strike, and then define that risk with another option below, you wouldn't necessarily have that break even all the way down at 107.5. So by doing this, you increase that probability of success and create a strategy that actually, while it's
the ego on you,
has a best case scenario at a stock price that is lower.
Thanks, Ace. Appreciate the gift membership. Son of Balti. You gifted to your son, so it's not really like a real gift. It's like you just gave it to your son.
Omnidirectional and high probability.
And of course, this name is also making a pretty sizable move.
Don't act like you missed. That was purposefully sniped. Don't try and hide it with another membership. I know what you're doing. You're trying to hide. You just gifted your son a membership. Thank you, sir. Appreciate it. You and Son of Bolty. Come thank Pop Ace for the gifted memberships.
We'll be looking at all things XPeng with
Sure.
a 27% move higher on an unexpected partnership with Volkswagen. We'll discuss more what that means for both of these companies.
You don't know what Weeble does? I don't even know. I don't know if I have share lending turned on any of my brokerages. It would only be Fidelity that really holds stuff long term. I'll have to look. And another one. Thanks, Ace. Eric D. I don't know what you're... Oh, you're trying to hit Dink. No, Dink and dodge, duck, dip, dive, and dodge. Thanks, man. Eric D. You've been gifted a membership by Ace. You've been summoned. High five, bloke. Playing his favorite.
The ego on you.
Yep. Thanks, Dad. I'm the gingerbread man. MNK. Almost back to VWAP there. We've got 30 minutes. 30 minutes to FOMC. You should introduce yourself. Tell everyone that Ace is your daddy. Make sure you've thumbs up. Join our Discord. In that order. You have 100%? Yeah, I gotta let it settle a little bit. 100% of the interest that they give you is what Charlie's cost to borrow. Oh, what theirs specifically is. Yeah, I'll just ask them. I guess I'll just ask whatever brokerage I hold the shares on. I don't hold them for very long, that's the thing, so it's not really worth it. It's something I'm not planning on holding for a while. I mean, maybe AMC makes it in the end? Doesn't go bankrupt? Dump truck daddy. SPY coming down, testing the lows again. I don't know how this sustains. Yeah, if you have a sizable position in barbecue though, and most people are trying to get one, and most aren't trading it, lending them out while you're holding is definitely smart, especially since you can't sell covered calls on it. And when you're loaning it, I don't think you can sell covered calls on it. So, but that's a nice way to have still that unlimited upside potential and making money back. CEO said they wouldn't unless they diluted. I know, but he says a lot of stuff. HMO. What is on the top here? I've got ALPSQ 1270. Beats your THMO. Thing is though, if they don't need your shares, you're not going to get the fee, right? So it's kind of, you don't want shares available either. Kind of a balance. ALPSQ is 1,273%. They paid a dividend? What? On OTC? That was before OTC. Barely. Buy's coming down more there. They have a freaking gold mine. Guys, come on. Gold. Everybody wants gold. Who wouldn't want gold? Pig grease. No, AMC doesn't care about any of that stuff. They're under their own deal with the ape conversion and the lawsuit and all this. BBIG down 11. Barcoding, the bottom of the barcode. Me above, below that resistance there. Got Teladoc bouncing off of VWAP. Tupperware back to the high. Interesting. Kind of a false breakout there, I guess.
Improved their ad targeting capabilities through the use of this AI technology after Apple back in 2021 implemented those serious privacy changes that erased about $10 billion off of Meta's revenue back in 2022. So the fact that now they're grappling that change, that was something that really impacted so many companies for the better part of the last 2 years. Meta has been able to weather that storm quite well. They're expanding on their Reels, which has been really,
companies.
I have to say, positively received now for several quarters.
There you go,
But
Eric
again,
D.
this name
Way to pay
also
respect.
pretty perfectly into this earnings event because we're
2020
up
beyond
30%
GME.
this month, only down 7% off their 52-week high, up 230% off their 52-week low.
Yeah, a couple things I think that'll be in focus will be how much money is still being spent in the metaverse kind of segment, the Realty Labs portion. Is that was really the story when this stock was struggling, was you're just burning all of the cash that you make. Yeah, the core businesses are strong.
Where are you getting these questions from, son of Pulte?
But if you spend all the money that you make on this technology, then
I don't know what's Snap doing, Smith. I had calls on it, which thankfully I sold.
So as that year of efficiency took hold, and we kind of see this return to robust free cash flow generation.
Yeah, it probably will have a bounce.
That's going to need to continue to be the story.
Let's see how it happened here. This is what I would wait for, settling down
kind of purchase
a bit.
ads on things
It just
like
fell off
Facebook,
a cliff and
Instagram,
needs time to recover.
Will be critical for this company. So I think this is going to be a pretty nice bellwether for the overall space.
But that said, there might be some nice option selling
I'm excited for this one, Jenny.
opportunities. Yeah, the premium's low.
Quarter,
IB crush.
Just because it's ran so far.
I know, and I really want more clarity on Threads because it was all we could talk about like 2 weeks ago, and now it's like, has that growth just stalled? Are we not seeing substantial user growth anymore? It's still a brand new social media platform, all things considered. So I want any sort of update on Threads.
Look to see if it starts to show some support around any of these levels.
Couple of earnings calls. That's always one I like to tune into because
maybe this week, maybe next week.
Barometer on the ad space, social media space.
A little bit of time. Could even come all the way down, retest these lows.
I mean, with
$8.
the outsized performance it's seen. So looking into lean into some of that, well, of course, I'd say being risk defined because this name can move, and we do know from earnings that we're typically seeing some pretty volatile events.
Let's strive to be in the future.
Yeah, I'm kind of cynical, so I think the fact
Hey,
we haven't heard
modern
that
science. A lot of stuff is possible.
Let's talk some trading though, because that is something that I think we understand pretty well. So let's look at
or if he's ever low on kids. I guess there's always adoption. Elon tweet? It's an X. I don't know what tweet you're talking about. Oh, I actually couldn't find it. I was looking for it and I couldn't find it. He tweeted not for long. Could you share it on Discord? I want to see it. I couldn't find it.
Calendar above the market. So like what we looked at in Southwest, except the bullish version. However, this one is a little bit more centered solely around this earnings event. Selling Friday, buying next Friday's options at the 315 mark. This kind of peaks out where this most recent move got to, and it also kind of targets alongside what that market maker moved, 1 standard deviation range. Looking at option prices sort of suggested as well. 315 is the best.
Is that up the Rio?
If that were to happen around the end of
Thanks, Ace. Appreciate it. CJ Lee.
Where this type of
You've been gifted a membership. You come thank Papa Ace.
So someone's got a more bearish view, a more neutral.
Fortunately, you're just collateral damage, but you don't have to look at it that way. You can still be appreciative.
This earnings event is, of course, on the calendar. They can move this around to better reflect whatever their particular outlook would be for the stock. So that's always the nice thing about the calendar spread. And you can see this particular one has a $1.50 debit price. That means $150 in risk. Is you can kind of
Eric, make sure you hit the thumbs up when you drop by. We got to start a new stream today. The one got cut. I was starting to buy barbecue, and then the short hedge funds turned off my internet.
Than somebody else, and you can express it using the same strategy because it's so tailored to that individual outlook.
Yeah, I think that's really well put, and of course, a way to play this major earnings event, which we will be watching very closely after the closing bell today. But coming up next,
who's Plute?
Look at another name that has earnings on the horizon. That is Mattel. You thought we were done talking about the Barbie movie? We're just getting started. We'll dive into what we can expect from their earnings coming up next.
Thanks, Jay. All right, 17 minutes till FOMC. Here we go. Yeah. we've got 13 minutes. If you guys want to read the FOMC statement, I'm gonna put it in. I'll put it in Happy DD. That's where it'll come out. And then we'll watch Powell at 2:30. 2:30. Good thinking, Cameron. What could go wrong? BBIG down 10.7. Maybe that's because you've been swimming with your phone, Ace. Still holding up in that barcode range. Alright, we've got 10 minutes. If you don't have your positions, take your positions. Probably calls right now as we're at the low. We could get a pump up here before it comes out. So far, let's see. I'm evenly hedged somehow. My puts are up 21%. My calls are down 18%. So I'll be looking to dump whichever ones go in my favor. Slowly. Little by little. Phone's about to die. Top actually consolidating above that breakout. So that's pretty bullish. Good looking. Dish hasn't made it back to VWAP yet. Excuse me. BBIG still down 11%. Barbecue up 3. Zoom's up 1.2. Zim is up 2.6. Teledoc's holding up so well. MacOS slowly melting. I'll probably watch it. I don't usually watch it live. It's not really at a good time. I watch it. I fall asleep to it. I read that Dink did that. I think that's awesome. I do the same thing often. Yeah, Pulley's going on. That's great. It'll squash all the misplaced expectations that he's this huge BBBYQ shareholder, and that's why he hasn't been on the show. That'll be nice to clear that up. I don't have some fascination with Pulte, though. He's just, I guess, another person to me. Very wealthy person, but I'm not thinking he's going to save any of my investments. He seems like an awesome guy, though. I mean, just himself seems very cool and genuine and like a good person. You can usually replace batteries. They're not like meant for consumers to replace. You just have to take them apart. Not a very simple process. All right, 7 minutes. Ooh. Which way first? Which candle first? Red or green? Might put a poll here. I guess just rip or dip, but I think it'll probably do both. But which way first? Green first? There you go, rip or dip first. Place your bets and hit the thumbs up. Or again, we got to reset the stream because the short hedge funds didn't want me to buy barbecue live on the air, so they turned my internet off. We're at 17 likes. Not bad, not bad. Got a couple greens. Yeah, I know. I share that. 5 minutes. I'll probably be watching GME along with SPY, as it's when I watch the most. That's a heavy correlation. It just moves with it at least.
Obviously, investment, and that's a function of having
Up to than 10 seconds.
And at the end of the day, it also signals a strong economy, a strong labor
That's
market,
20.
a strong economy.
Let me see. I'm sure you can replace those. It'd take work though. You probably have to like melt the glue and stuff.
At least this year, or even since October of last year, based upon the fact that even as rates rise, the economy still is very resilient. So I suggest that, you know, if the Fed remains hawkish, we may end up seeing quite a bit of volatility. That is to be expected on days like this. But unless things change,
Oh, nice. You can actually get to it from the back.
Really a dire earnings outlook from
You don't have to take the screen off.
on a forward basis. The market
Yeah,
is
but you have to pop the back off. Not bad.
Rhetoric the Fed may maintain.
You could do it, Ace.
Just so again, keep in mind, hawkishness.
You're not very technical though, maybe, so maybe not.
Doing well, and I think the Fed
It's actually fun doing this kind of stuff.
Because you have to
if you're gonna just throw it away anyways, might as well try it.
Interest rates. If you just use core inflation, which is still elevated at 4.8%,
I enjoyed
the Fed's
taking
target is going to be
electronics apart.
Midpoint between 525 and 550.
Little guitar picks. I've got a little squeegee. That's nice.
We're just barely above core inflation rate.
Yeah, it's all. You probably have to heat it up a little bit. This is a heater thing. You don't need that though. You just heat it up with like a hairdryer. Not too hot though. Loosen up the adhesive. Pop it off. That's easy. Just follow the directions.
15 years worth of normalization in
pop off the connectors. There's the battery.
The market
it's still suction cup.
well. And I think that there's no reason for the Fed.
You can pick up a battery for what, 20 bucks?
Conditions are robust, GDP is robust, and even the
Yeah,
market
17 bucks.
performing well for the Fed to become dovish. The economy is still robust, and I think that's one of the reasons why they'll remain hawkish. And it may not necessarily be a bad thing for the markets.
All right, 3 minutes.
George, I think it'll be really interesting to see if the Fed puts more emphasis on that stronger than expected activity we've seen throughout the markets, or then the weaker than expected inflation. It'll be interesting to see what they focus this narrative on, which I always think is so critical, and why you should tune into Jerome Powell's press conference. It tells you a lot about the overall sentiment, I'd say. But we will leave it there. Great breakdown now ahead of that Fed announcement. George Tillis, senior markets correspondent for the network. That also does it for Alex and myself for Next Gen Investing. Coming up next, we have all of the Fed coverage on the watch list with Nicole Petalides.
Here we go, a little Yaz for the FOMC. No, it's fine. It's fine, he voted RIP. Pretty even though, huh? You guys are pretty even on the rip or dip. Dead even. 12 votes. 50-50. Minutes. All right, I don't have any futures open, which I might open. If it does a huge rip, I might open short and vice versa. Since I don't have any futures right now. What I do have open, I will probably close out in the first, I don't know, 30 seconds. At least one leg of it. Here we go. Split candle. What'd you guys vote? RIP. 53% say RIP. 47% say dip. I'm down for both ways. That'd be great. I just want it to go way up and way down. I'll probably just go way up or way down and then back to the neutral though. All right, here we go. That's it. It's out. Little red first. Oh, wow. Tiny little red candle. Look at that thing. No. I don't know what to close. I could have closed my puts there, I guess. That wasn't enough. Tiny reaction. It's probably just what expectations were. Ivy just getting crushed on these contracts, I bet. 25 basis points, yeah. The wording is not unusual either. This is the smallest reaction I think we've seen in a long time. Wow. You could have closed before it even came out and made more. Look at that. That is crazy. Well, we still have Powell. Powell will give us some volatility probably. I'm still up on my puts actually. Maybe I'll close. Oh, never mind. Too late. Hey Rock Solid, what's up, man? Good things about me, huh? Well, that's good to hear. just missed my put close. This reaction is so muted. Wow. You could say. Even GME had a weird candle there. Alright, I think I'm gonna close my puts. Okay. I don't like to be one-sided on this, but the reaction is so small. I'll just ride my calls and hope something's bullish. Get a ban. You voted dip? Ban. It did dip first. I was up on my puts. Should have closed. That's crazy. I mean, this is almost like pre-interest rate hike reaction to an FOMC. I mean, this is probably even more than it was then, but still, we're getting back to when it didn't matter. These meetings, or matter as much. That's crazy. See? I set it up so everybody wins. You guys are all right. You got the dip and the rip. Isn't that nice? I make sure everyone's a winner here. Powell Streak always, sometimes it rips. Sometimes it rips first and then you get kind of a dip towards the end. Don't say that, Jay from the Bay. I just sold my puts. I was up on them, that's why I sold them. If I was up on the calls, I probably would have sold. I would have sold both. This was really the reaction I was trying to get. But didn't get it. There was probably a point in there where my profit on my puts would have covered the cost of my calls, but it was just too quick. That reaction was tiny. That's crazy. All right, Liechtenstein, what do you got?
Well, you know, I think they definitely have to weigh some of those additional firming downside risks ultimately, right? We have been hearing a lot about, well, the impact that higher rates had on banks, and a lot of people
might even go long on the futures for the rally up to Powell. J. Powell.
Something breaks, and a lot of people focused on labor conditions. We'll get a little bit insight in terms of that as far as the weekly jobless claims tomorrow. But again, the Fed raising 25 basis points, I think it's pretty clear that we're kind of working our way towards the tail end of this cycle. Nicole, there could be a couple more to come. I think they're going to stress data dependence. The focus is going to be now on Fed Chair Jerome Powell's Q&A session. But yeah,
just chill for a bit.
Again, well received, I guess, is the best way of putting it in terms of market reaction to the initial reaction to.
Yeah, and look, we'll get the PCE this week
tomorrow,
as well.
yeah.
That is the Fed's favorite.
I thought that was on Friday.
As far as, right, that'll be on Friday. We'll get you.
Come on, Liechtenstein.
They're saying that they are committed to returning to that 2% objective, and there is talk that.
Wow, that's a tiny reaction. Even when it was exactly what we were expecting, market still would give huge reactions.
Jackson Hole language, little tidbits. That's going to give us a little clue
Crazy.
into what happens into September, maybe.
Yeah, I mean, the Ultra Bulls ultimately want to hear something definitive in terms of more along the lines of a pause, right? But the Ultra Bears keep pointing to the fact that, as you mentioned, while we have seen inflation easing and that rate of acceleration coming down significantly, we're still well above the Fed's 2% target, which kind of suggests, again, that there's more work to do. So I think that's where the focus is going to be this afternoon. And then lastly, I want to
well, if we're looking back at TA, I mean, if we don't get a huge reaction from this, we're in a cup and handle. So really bouncing on this level is that's all we need for that handle, and then we're back up to those highs.
Multiple focal points here this week
So
in terms of
I'm fine with the long exposure, honestly.
Friday we were talking about, but also the ECB as the dust settles from the Fed. But keep a close eye on the Q&A session, which is headed our way in just about 25 minutes, Nicole.
Yeah, saying the extent they're determining.
Yeah, I'm gonna take a long there on the futures. I like to melt up into Powell. Things dance around a lot still.
Particularly hawkish. And you know, we had on earlier today. We had Andrew Brenner on.
32.55. You bought up it? No, you didn't. Stop.
raise again in September.
No, it's looking good. I picked up some this morning and today.
And that it was
I didn't have anything.
they should have, as you said,
Oh, I'd sold out.
They should have just paused and maybe really
Sold out
just ended
here.
that rate hike cycle altogether.
Here.
Ben Lichtenstein, great to see you. Host of Futures here on the TD
Here.
Ameritrade Network. Thank you, Ben. Let's welcome in Josh Saylor, partner, Blue Zone Wealth
Yeah, I'm
Advisors. So what are you
back to accumulating here.
hearing from the Fed? I mean, on the
Looking
one
nice.
hand,
I like
they're
it.
saying they still want inflation to come down to 2%. At the same time, noting that tighter credit conditions could actually weigh on economic activity, hiring, and inflation.
Yeah, I mean, today was baked in the cake, as a lot of people are going to say for the rest of the day. I think the important thing to try to keep our eye on is how the consumer fares from here and how we see top line sales coming out during the rest of the year for earnings. The other major question that we really have.
All right, so we got Powell in 20 minutes.
We don't see this.
We can read the
bond market was
read the thing. It's not much to it,
attempting
probably.
to price in towards the end of the year. Likely not going to happen, simply for the reason that you just stated, which is this last couple of percentage points to get from this 4% range down to 2% target. That's likely going to be the stickiest piece, and so we'll know more this week. As they release more information, but I think that they're going to be very dovish in their commentary and likely stick with that data-dependent rhetoric.
Look, the 2-year Treasury yield dipped slightly. I was looking at the 10-year up here on the big board. It's still basically at 3.88 from 3.89 moments before the announcement. But in the meantime, the concern is about the long Treasury.
So usually the verbiage on the statement is causes more of a reaction. I guess there wasn't much on here.
And this is conversations that we're having with clients on a day-to-day basis when they see what the overall indexes are doing, which is still, not a good indication of where the economy is today, with 7 stocks being the majority of the gains here. That said, the yield curve has been more inverted for a longer period of time than ever. And, you couple that with 15 months now of leading economic indicators being negative, we can't rule out that a recession is still somewhere looming out there. And the question is whether or not that's what we need.
These futures contracts aren't moving at all.
Right, understood. So what are you going to be listening for specifically? I mean, I feel like we're going to get much of the same.
I think it's halted.
There's always something, and that's why I like to say how important this day is. There's nothing humdrum.
The futures market halted?
While markets may not be moving crazily one way or another.
E-Trade looks fine to me.
At any moment, any one of these lines from the Federal Open Market Committee can really jostle this market. What will you be listening for in the presser?
Yeah, it's a really good question. I think the majority of what we're going to be listening for is more around the lines
my futures
of
is not. They're not moving.
Really going to be considering.
There's a micro ES.
And while there can be
not
arguments for
moving.
both sides on employment being a very lagging indicator, it's how are they peeling back the layers of the onion in
Clock's
terms
still
of
going.
employment, in terms of payrolls, initial jobless claims. How
What's
are
going
they
on?
taking a look at that data and saying whether or not this is a healthy indication of whether they can stay the course, or do
The
they
banks
see
are sound and
additional
resilient.
storm clouds on the
The
horizon?
banks are sound and resilient.
At this point
The
now,
banks are sound and resilient.
there's a lot of folks saying the Fed should have stopped or should stop right here.
I don't see any news about futures stop trading, but mine are frozen.
Over the last 18 months, brings us to the highest Fed funds rate in 22 years. They themselves, from the committee, noting that they're looking at the cumulative and lagged effects of the past rate hikes. Why not stop here? I mean, could inflation really jump up so terribly
It's so weird.
or go back
I've never
to
seen
those
that.
40-year highs like what we saw and higher?
It's happened before, and I think that that's what they're trying to avoid more than anything, is having that type of an economic experience again. And so if they are believing
Highs
that
coming up
the
here. Everything's
economy
working except for the futures.
deal with the hikes, even though
What?
these lagging effects have taken probably a lot longer than anyone really would have expected, despite the pricing of the market right now.
To show you the IV crush, those calls are still down. Those calls that were green before the release. Oh, they weren't green actually. They were green here at VWAP.
It's tough to say.
I'm still down on them.
We won't know until we know. It's tough to say whether or not they should stop. I do have a feeling that they can't keep rates where they are indefinitely. However,
I need a
I
coffee.
think they're dedicated to any ramifications that come in order to reach their target again. And it's been wrong. It's been wrong to say that to fight the Fed, frankly.
Yeah, let's talk about how a lot of the market moves that we've seen have been driven by the Magnificent Seven, right? You talked about how some of these large cap tech names have driven the market. It's broadened out some now to help indices along, but that was something that was of a concern to you. At the same time, you sent me a quote from the conference board about a recession being likely.
Yeah, the market is not the economy, and the economy is not the market. And as prudent investors of capital, we have to consider all of these things when taking on investment decisions. And risk management is our primary mandate, especially right now. And so when you see a market that has been driven primarily by multiple expansion, with the underpinnings of this sort of AI exuberance, not to take anything away from it, it is very transformational, just potentially maybe premature in terms of the way that some of these names are pricing. Then you've got this rapidly falling inflation, which is something that you brought up earlier. I think what might get missed is the fact that the top line earnings growth really depended on higher inflation. And cost cutting really helped to improve earnings in the previous quarters. And if inflation is falling faster than we would have expected it to, from a monetary standpoint, that's good. From an earnings standpoint, maybe not so good, because a lot of these companies were relying on that pass-through of pricing in order to maintain that top level growth. So if that's not there anymore, what does that mean? What does that mean for earnings? And will the fundamentals eventually catch up?
Look, borrowing costs now are at the highest levels in more than 2 decades now with this rate hike today, and they've basically resumed this pattern that they started back in March of 2022, and there is no end in sight at this moment. So we are still fully immersed in this rate hike cycle, and people are betting when they will stop raising and when they'll actually cut. Will that be first or second quarter next year? There's been so much talk about that. Josh Saylor, thank you so much, partner, Blue Zone Wealth Advisors. Glad you were with me on this day where the Fed just raised rates by another 25 basis points. Coming up, we're going to head out to Washington, D.C. We'll hear from the Fed Chair Jay Powell. The press conference starts at 2:30 p.m. Eastern Time. In the meantime, we will continue looking at the reaction here for the markets. The Dow is higher. It was up 5 points. Now it's up 27 points. The S&P had been down 11. It cut that down to half. It's down about 5 here. So you see markets improve slightly after our latest words that we've heard from the Fed. More to come. We will be right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, They're made by them. Thinkorswim Trading from TD Ameritrade.
It's a 13-hour flight. That's not a weekend trip.
15 minutes away.
Look at that volume on barbecue. Thing might be about to break out. That's pretty big. Setting up a little bull flag here. Powell on 13. Futures market still halted. Yeah. Still frozen. What's going on there? Futures are trading again. We're back live. Buy's climbing up a little bit. Yeah, that volume did bring some price action on barbecue. 420, 31.48. BBIG still melting down. Tupperware holding up nice. Tempting. .27% on barbecue, 31.50. Teladoc just bounced off VWAP and still up. Wow. Oh, Nick, what happened? Yeah, this was looking weak. I didn't fully get out of my calls. Most of them. Zooms up 2. Zooms up 3.4. Now the futures are moving a little bit.
And they want maximum employment. Right now we have
all right, 9 minutes to Powell.
Jobs numbers are good. The job market
see these calls up.
Robust.
No, calls are still down.
Remains low, but inflation's still stubborn. And PCE, although it went down, it's not at 2%. We're at 3%, and the core PCE is at 4.8. So we have a little bit more work to do. But I think we're coming into the 9th inning of this, and I'd be interested to see what Jerome Powell thinks as far as what additional hikes may be appropriate.
And then we have
we're crossing the finish line
stock market crash.
Within the markets.
Look, there's a lot of folks who think this is the last one. And get
whoa.
Maybe he'll allude to the fact that they can
ready for Powell.
or C or something like that. In the meantime, let's talk about specific sectors and things that are happening. Housing was the first to quickly turn into a recessionary type of environment. That quickly sold off, right? Housing just sort of paused as we
Is the
went
stream
from
still working?
3% to 7% on mortgage rates. They've sort of been bouncing around of late because I can't say they're off because they were off, but then they crept back higher in the last
It looks
few
fine on
weeks
my
or
end.
so. But rents have been coming down a little bit. Home prices are still high. You look at rental cars, used cars versus new cars. People are still facing high costs.
Oh, 100%. So the job's not fully finished yet.
Thanks, Mark.
It's going to be.
I don't know. Everyone was chatting for a while and then just got silent. All of a sudden, everyone just went to lunch.
But also, too, he doesn't want to put us right into a recession.
Cool.
It's like we're driving a car headed towards a cliff.
But he's willing to. You know he's willing to. He really doesn't consider that as a big problem.
Yeah.
He really doesn't.
Yeah.
Back west,
and that's
bounce
gonna be
back
the
up to
challenge.
VWAP.
Right now, if all things considered, if this was our last rate hike, we're going to look back and say this was a soft landing. But if more rate hikes are needed to cool off this economy, and there is cracks, like you said, right? You look at housing.
Fly back down to VWAP.
Try to go to a bank right now and actually get a mortgage, or
Unexpected
even
fireworks.
a
Time to
commercial
go home.
mortgage right now. Banks are becoming tighter and tighter with their lending, and that's going to bleed through the whole economy. And the whole purpose of the Fed is to slow down the economy, slow down the money supply, and fight inflation. And it's just going to take time. And I think it's smart by raising 25, giving the market exactly what it predicted. But a lot can happen between now, Nicole, and in September if there's breaking news with whether it's higher unemployment or stubborn inflation. The Fed can change their mind and pivot quickly because, like you said, you know, he's a little reluctant, or he's a little bit straightforward to go to that cliff without the brake.
Yeah, he's willing to put the economy in recession rather than risk high inflation once again and have it turn around. That being said, with borrowing costs at this extremely high level, we're at the highest level now with this rate hike today to the 22-year high. In the meantime, you have tighter credit conditions that the Fed themselves say is likely to weigh on economic activity.
Nicola's up 9.
Labor, basically hiring, and inflation. Okay, so the inflation part,
AMC's down
we're trying to
3.
get down. But the other things, I mean, they're going to watch wage growth. They want to see what's going on with the economy. And
BRM's down 3.
I'm not sure people are really prepared for a recessionary environment. There's been talk about bankruptcy.
Ivana's down 2.
Coming for businesses. You have the ECB likely to raise tomorrow, which, right, they're likely to raise 25 basis points, and they're already seeing bankruptcy for businesses happening there. And Bank of Japan's on Friday. They're likely to just sort of stay steady. But your thoughts on what these businesses are going to be up against?
So, you know, it's funny you mention overseas, what's going on over there. I think we're the tallest midget in the world, and that's a very good point. If you look what's going on in the UK, they're projected to have a 6% terminal rate. That's their Fed's funds rate. You look at the ECB, they're looking to project at least another few more rate hikes. So the rest of the world is still in a tightening cycle, which could bode well for, having a little clairvoyance here and
Disappointing.
completely out of the woods with this yet. And as far as banks go,
Yeah, it's hilarious.
Just a few months ago.
It's actually really nice though if you believe. If you believe.
Especially for these smaller banks.
All-time low double. Spy's coming down here. 5 minutes to Powell.
Where they have old mortgages at 2%.
Because the news is still bullish, so it's kind of a gift that Wall Street bets
the debt doesn't support the loan at
just
7-8%.
flooded into calls and dumped them at open.
Absolutely. So
IV's still pumped, which kind of sucks, but the price is nice and cheap. I think there's a lot of upside potential with this.
Investors as a whole. So again, I think it's going to all eyes.
Yeah, we were getting some weed stocks pumping today. Isn't this a weed?
To see if they have a hawkish tone or a dovish tone, and most importantly, see what their prognostication is.
Oh, liquor? Yeah, cannabis.
All right, Mario Veneroso, thank you so much, Kingsview Asset Management. Glad you were here with us today. I'm seeing the Dow up about 40, had been up about 5 right before the announcement. The S&P is off its lows, but still in the negative right now. We'll be right back. The Fed chairman moments away, so we will bring you live to Washington, D.C. when our Fed Chair Jay Powell speaks. Keep it.
Market's selling off before he comes on. Interesting. Weird. I guess hedging my calls with some shorts in the futures would have made sense. I don't know. I'll wait for him to talk, see what happens. M-word? I don't know. Is there any catalyst today for all this volume? Nova Cannabis further extend outside date for closing partnership agreement. Oh, it's just from Tilray's earnings. Yeah, I mean, I'm not... not overly hyped on this chart. Give it some time, Ronald. And a spy wick. Tupperware. Back to the highs there. Yep. Flip the resistance into support. And off she goes.
You know, if the economy is still continuing to remain robust, they may maintain a hawkish tone. And I think at the end of the day, one of the concerns, at least in my view, is when the Fed is starting to you know, be a little bit too dovish, or if you look at the yield curve starting to widen out, meaning short-term rates are falling faster than longer-term rates. That's, to me, that's more of a concern than remaining more hawkish.
Yeah, and the truth is, I think a lot of people think more likely than not that Chair Powell will stay a little more hawkish because he can. You know, there's more downside risk if he were to play a dove card right now. There's no reason to. The next meeting is not until September, so he could just sort of stay the course, you know, sort of soar through the next month or so.
All right, J Pow Pow. Let's hear it, bud.
They love to look at. In the meantime, even
Make my calls go burr.
growth, they've upgraded economic growth now to moderate from modest. So they see that the economy has not slowed so much. Inflation has come down, but these are the types of things they're watching for: wage growth, housing. You know, it seems like we're still doing okay here.
Well, yeah, at the end of the day, if you think about raising rates, ideally speaking, they're raising rates for a good reason. I mean, obviously it was to subdue inflation, but there's high demand for investment spending to, of course, produce more goods and services, to, of course, stabilize inflation rates and keep the economy going.
Behind the podium shot.
The Fed may, I can't say what they will say.
Well, good afternoon.
To an extent or
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
This is all a pre-written speech.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. and higher interest rates and slower output growth also appear to be weighing on business fixed investment.
There you go, rip, rip.
The labor market remains
All
very
are still
tight.
down.
Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation,
almost high of the day, high of the day.
Risks. We remain committed to bringing inflation back to our 2%
We've made our handle.
and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions.
Calls are still down.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking.
That question could have really dumped the market.
We're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report,
still down.
1 month's data. We hope that inflation will follow a lower path but it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. And we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments.
Hold steady at that meeting?
By meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there.
That's pretty dovish.
You said the data in the intermediate
period. He's acting like he's flexing on how good they've done.
In line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data.
Back to those highs. What did we say?
Many forecasts call for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing performing well this summer. Is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that?
Only up 60%, like not a huge one.
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy.
Oh, the futures look good, though.
So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil
With the options
from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating.
There we go, breaking out of that high.
So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
Cup handle. Now we're back to the high.
So if you go back to
look at that.
What we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing.
I'll leave this last one.
I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it. And so we did take that step today.
Nick Timmer, Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter. And that by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points.
456.96.
Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way.
15 minutes to power hour.
I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far.
50% retracement on that handle.
Most economists think that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. You know, there's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is
it's
a
fluid,
very
you don't know.
positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And you know, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and you know that's the thing that
doesn't like him talking so much about that.
Need to avoid and will avoid.
Yeah, that guy took way too much time. Yes, like multiple questions.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures.
This last call.
And what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
You'll soak in all the markets.
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to
someone else said
slow down
soft
the
landing,
decision
I think.
cycle as we,
I don't know if he specifically said it.
Get closer and closer to, we think, our destination. And
Kevin
I
Malone?
wouldn't want to go automatically to every other meeting because
A basketball
I just don't
player?
think that's, I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of
that's
uncertainty
Karl
out there. We
Malone.
just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that, and I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah.
Oh, wasn't you, Pow Pow?
So,
that's what she's saying.
Interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, Of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. And take autos as an example. The combination of an increase in sales and inventories,
Hold on, son, I'll look at it.
While vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing
not necessarily.
So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said input cost pressures remain elevated for services firms, but ease notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things, and we'll keep an eye on them. But really, that's something that's handled at that level, and
not my job.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole on a wide range of things. And when people are writing down rate cuts,
oh, MNK written back up.
You know,
there's your day trade days.
It just is a sense that inflation is coming down, and
To
we're
watch this
comfortable
one,
that
it
it's
was
coming
a
down,
mover.
and it's time to start cutting rates. I think.
Got 26%
But I
move.
mean,
when we
there's a
mentioned
lot
it.
of uncertainty between what happens, you know, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, you know, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then. A full
I don't
year
think it's ever
from
said,
now.
I don't think.
It'll be about how confident we are that inflation.
He's only
is,
said
in
no
fact,
rate
coming
cuts this
down
year.
to our 2% goal.
Interesting.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think, you know, that's sort of consistent with what I see today. So, but it's a long way from assured, and you know, we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment.
So
We've seen
wise,
softening through, you know, job openings coming
It's
down.
really raised you well.
Part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, you know, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and you know, we hope it continues.
I'll take us to Mars.
Thank you, Mr. Chairman. Jeff Cox from CNBC.
Hope you get on the PP show tonight.
You and other Fed
Talk to
officials
Pulte,
in the past have
as the son of
suggested that
Pulte.
you don't need to keep
Why is it
hiking
coming down?
until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And you know, how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So in fact, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell.
Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt? Or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized.
Even Dish got a little
remains strong.
Drop from that.
Aggregate bank lending was stable quarter over quarter and is up significantly.
BBIG actually
bouncing
on that.
Sector profits generally are coming in strong this quarter, and overall the banking system remains strong.
For BBIG back to BWAC, maybe.
Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were, affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and
well, he said they'll be cutting long bore, or they'll.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
this goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel, or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long, or if we don't succeed, that the pain will only be greater. So
MNK, look at that.
That's how I would explain what we're doing.
Jeez, 150% now.
Thank you, Chair Powell. Simon Rabinovich with
64%
The Economist.
when we were watching it.
You had said last month that this meeting this week was going to be a
Break a
live
VWAP.
one.
Back to the
In the
highs.
event the market had assigned a roughly 99% probability to
There's
the
your day
rate
trade,
move that
Ace. Where are
announced
you?
Today. The decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, you could.
What kind of question is that?
Was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
That's kind of a wasted question.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
BBIG might be a nice entry.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to to show that they are prepared to use it? Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do
purple.
that, banks broadly.
DRS or GME shares.
We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
They took her mic. Baker's buying took her mic. That was hilarious. Oh, that's nice music. The event has now ended. You may exit your seats. Exit rows are marked with the white lights, one row at a time. BBIG little pop up there. I like that. Let's see here.
On
Get these guys talking.
in particular, and the cooling versus a year ago, he doesn't seem to be really giving a lot of credence to the better than expected data that keeps shocking.
I like BBIG actually.
3-4 months.
Yeah.
Maybe too soon though.
We talked about this last time I was on, that the interesting
Probably
thing
gonna move
about
back to
where the
VWAP.
Fed is
Wait till
that
tomorrow.
They're still way above. Inflation's still way above target. So it's hard to see any scenario in which they're cutting rates, I don't think, before even the middle of next year. And so we're going to find ourselves in
K
this
had a
very,
nice
very restrictive
70%
policy
move
environment, I
intraday.
think, for probably at least another year. I mean, even looking at just
Till raise
the
up
2 years, the 2 years,
15% now.
currently at like 4.75. So we're looking at, an expected 2-year average yield on the Fed funds rate, I think, of something that's still very restrictive. And so the question is as we navigate into the back end of this year and early next year, is how much does this impact credit markets? And does this start to turn into more of a credit risk environment? I've been saying that that's really the big risk that people need to be focusing on. And so I think looking at things like credit spreads and, the bank performance is reassuring. You don't want to see the banks continue to deteriorate. So that's kind of
Close this long back at VWAP.
Piece of good news, but it'll be interesting to see the longer the Fed stays restrictive, the higher the risks are across the credit system as more and more credit has to roll up into these new higher rates. And nobody really knows how smooth all of that rollover is going to be.
Okay. Real quick, with PacWest's overnight scare getting taken over, spurring this big rally in banks, how far does that chart go before we say, all right, that potential credit risk is gone?
Yeah, honestly, I find it hard to believe that
Wall looks really nice.
Going to continue to be under enormous pressure in this environment, just because they're the ones that have this huge asset liability mismatch on their balance sheets, and they have to
break out.
This is something that just is going to take a lot of time for them to roll over, because they're incurring this higher cost of capital on the short end, and they're trying to roll over all of their assets into new, higher interest-bearing loans in essence. And the demand for credit just isn't there. So if there's one really worrisome thing that you see in the broader economy right now, it's the fact that total lending has cratered. I mean, we were averaging 7% per year basically for the last 5 years. And since the Fed started raising rates, new loan growth has cratered to 0%. So it's going to be really important to see that start to stabilize. And if it doesn't, then to get economic growth, we're going to basically be relying on a huge amount of government spending and government deficits. And so far, I think deficits have sort of offset a lot of the monetary policy contraction that we've been seeing. But going into 2024, it's not clear that that is going to continue.
Okay. All right. Nice transition for us. Talk with Stephen.
We get another flat day on barbecue tomorrow. I'll pick up some more.
Thanks a lot for the convo. And
looking nice. Little inverse head and shoulders here.
For us to build our analysis this afternoon. Joining us from
Ladder up.
Funds. Let's bring in Stephen Moore from Freedom Works. He's a senior economist who has been critical about the Fed over the last 18 months for the most part, and kind of chasing their tail admittedly around the transitory stuff. Stephen, do you feel that Powell is doing the right thing by stepping off the throat of the economy a bit here, taking it slower, or does he run the risk of doing transitory part two, inflation comes back?
Well, look, we have inflation still in the 3 to 4% range, and so that's significantly above the target. I think it's interesting that it was unanimous on the Federal Reserve Board that they raised rates, and I agree with your previous guess that I think at least one more
MNK looks like it wants to break out.
Offering. The dilemma the Fed has, of course, is that when they raise interest rates, that slows down the economy. It puts more financial stress, for example, on the banking industry, and yet they have to get us back to the 2% inflation target. So not a real happy time to be on the Federal Reserve Board, but I think on balance, I probably would have voted for this rate increase as well. And one other quick thing that people have to realize is that, this is about the steepest increase in interest rates in history. To have 11 rate increases in a little over a year is an enormous increase in rates over a very short period of time. Now, that has meant that the biggest victim of this has been the United States government, because the government is the largest borrower. I don't know if you've looked at what's happening to interest rate costs on the federal ledger, but it's the fastest growing expenditure in the budget now is interest on the debt.
The potential on the combination of monetary tightening,
MNK almost a new high.
A little bit, but it's still there. We're still hiking rates. Obviously, we did a ton, as you mentioned, and I heard from our previous guest, Colin. He thinks that the economic negative impact of those rates has been somewhat offset by a willingness to partake in deficit spending still, and a few stimulus packages last 18 months from this current administration. What do you see as the appetite for that going forward? Is that just kind of a baseline expectation we should expect our leaders to continue to do?
One of the things that people have to understand about what's going on in the economy right now that hasn't been widely reported, but Vivek Ramaswamy, a presidential candidate, and I had a piece in the New York Post the other day about this, and I want to call it to the attention of your viewers, that over the last 6 6 months. That's more than
Yeah, no swing on Dish. I think we'll get a to continue to go up though.
combined. So what I'm telling you is
I mean, it was in a nice
the economy
uptrend.
is
This
growing right now in
Wall Street
all
bets
the
just
wrong places. The government
messed
should
with
be
it.
contracting. COVID ended 2 years ago. There's no crisis. We ran up.
It was at a
trillions and
resistance
trillions
too,
of
so
dollars of debt.
I think they'll have a
During the
continuation on
time
this.
The government should be shrinking. It's actually growing. That's the worst of all scenarios because it's expanding the debt and the deficit. And you know, the more the government hires workers, the more it contracts the private sector. So I find that to be a big concern right now.
What about the lack of extreme wage inflation that could have really sent us into a bad spiral here? Do our leaders get some credit for avoiding that, or is that building? There's certainly some strikes happening right now. There's some labor intensity, debates happening. UPS did just get to a resolution, but what about that story?
Well, that's the big story on the economy right now. I think you're right to ask about that. You know, as a Republican working with some of these Republican presidential candidates, what we're hitting Biden on the most is the fact that the average worker is about $4,000 poorer today than they were when Biden took office when you adjust earnings and wages and salaries for inflation. So that's why you have 65 to 70% of the American people saying the economy is headed in the wrong direction, and why it's a fantasy for Biden to say, oh, look at all the wonderful things I've done for the economy. Not for the middle class. They don't see it. They're getting poorer. Now, why is that? Because inflation in something like 21 of the last 23 months, inflation has outpaced those wages that you're talking about. Now, it's interesting because in June, we actually saw for the first time in a long time.
MNK new high there, 1190.
Above inflation rate.
Jeez.
And workers want raises. That's
$1.20.
what happened with the UPS package. That's a big wage increase for workers.
This might be an after-hours mover too.
See that happening continuously. We're going to have some wage.
See how it holds up in a close.
Well.
I want to pull up a chart that he brought here looking at the inflation rate versus earnings. I mean, this is basically the visual capture of that, right?
That's right. That's exactly what I was talking about. You know, so you can see the green line there is the inflation rate, and the blue line is the inflation rate, and the green line is wages. And you can see under Trump, one of the things we were proud of is, you know, I was one of his senior economic advisors.
87% from
big wage
open to close here.
American
intraday,
according to the Census Bureau, had a $6,500 real increase in incomes in that period. And then now what you're seeing in the last few years is that the inflation was way above the inflation rate. And that's the middle class squeeze that's a big problem right now for middle class families.
Do you think there's going to be pressure coming around election season, as we've also got student loans coming back on? Do you see the conversation coming back towards minimum wage labor type of discussion that could present a problem? I mean, that would be a bit of a wild card for the central bank to have to deal with.
The problem right now isn't minimum wage, it's average wage. You know, I mean, only a small percentage of workers get the minimum wage. So, you know, and I would be opposed to raising the minimum wage because those are starter jobs and a lot of teenagers and so on. The problem is that what I was showing you on that chart is what's happening to the median wage, and that is not rising fast enough. I think that we should pay close attention to that UPS deal, because as I look at it, boy, it looks like the workers the union got a pretty good deal. And that means you might see more agitation by unions to raise wages, looking at what happened and how the Teamsters really got a very good deal from the UPS. I'm going to anticipate you're going to see more and more agitation from unions for higher wage increases in the future.
MNK almost 200% there.
Bipartisan prediction that both sides can agree that type of conflict is coming. They might want different results, but it does kind of seem like a bit of an inevitable clash, like the angle.
But let me
go ahead, Stephen.
Let me make something clear.
Sure.
I mean, I'm in favor of higher wages for workers, but there's also, you know, if the wages are rising faster than productivity, that by definition causes inflation. So people should, you know, that's why we got to get productivity up, and productivity has been really lagging in the last couple of years.
Extremely fair point. Thanks, Stephen, for your thoughts and contribution. Appreciate it.
Thank you.
Absolutely. Stephen Moore.
This thing's about to get halted.
All right. Let's let that simmer for a moment.
132. It's up almost 200%. There's 200.
Options. Intel on the list. X paying after a big day, and also the trade desk. 2 bullish trades, 1 bearish, but they're all up as the market is hanging in there. Not a bad little sign of stability here. Post-Fed, post-Microsoft, it's a mixed market. NASDAQ's still down, but pretty much where we've been all day.
See if $1.50 is resistance. FOMC. Okay. I like the shares and share lending on that. Fidelity does 50%. Yeah, there's the halt on MNK. Yeah, if you like AMC, do the shares, lend them out. Or you could do covered calls. I mean, you make more on covered calls with it with probably the premiums, but if you wanted upside exposure, 50% is crazy. Oh, never mind. It's come down a bunch. It's 280% now. Now it's the same as barbecue. Wow. GME trade's 100%. It's 100% of what their rate is, though. I know you did, Cameron. I just didn't look at how much it collapsed. The volatility event is over. Yeah, someone, it was Cameron or someone was saying, I think it was Dink. With Fidelity, it's 100% of the rate that they get, basically. They just have to look at what their rate is. And probably same with TD Ameritrade. So it's going to vary from brokerage to brokerage, it seems like. And it varies from day to day as we've been watching. Beyond? %. Yeah, I don't like any setup on here yet. We'll see it bounce off of this trend. Climbing back to VWAP. I'll close along. Hit VWAP or thereabouts. I mean, the options IV didn't collapse, I'm assuming, on AMC. Still probably paying a huge premium. Actually came down quite a bit, huh? I don't remember what this was before, but I think it was a couple 100%. Wow. We got a little head and shoulders to end out the day there. I mean, case maybe it'll resume before close. And that's where I close my longs. All right, it worked out. It's too bad I was heavier on the put side. Didn't quite set it up right. I should have done both of them at the money. Otherwise, the setup today was good. I got calls here and I got puts here. Top holding above this breakout level's pretty gnarly. Probably need to get a position on here with a pullback. Sell some calls.
Crazy move, big. I mean, pretty exciting stuff. EV revolution, very, very real. I was watching a fun video with my old Bloomberg colleagues. Matt Miller did the BMW SUV. That's like, it's pretty cool
Mercedes
video.
SUV.
Yeah, sorry, the Mercedes.
But they did a comparison before, about 3 months ago, between the two, the BMW versus the EQS, the Mercedes. And BMW. A little bit better.
All right. Well, everybody's going after it right now. And there's a lot of money behind it. Okay. XPeng doing well. All right. Let's talk about
MNK resumed.
Trade in Intel.
Woo.
How come?
$1.44.
Earnings tomorrow after the close. I think that's going to be a catalyst. The stock's
Over 100% from the support
so far
bounce
year,
today.
So it's made some inroads. It was. I saw an interesting note out of Jefferies this morning based on Google, Alphabet, and Microsoft's earnings. Regarding CapEx and AI spending on the earnings calls, that Jefferies believes that the above consensus estimates from NVIDIA may prove conservative, that the firm noted that AI was mentioned 170 times on the call, and this is going to be a positive for NVIDIA as well as AMD and Intel.
Safe 150 resistance.
So basically, they said the guidance that NVIDIA gave is actually going to come in light, and that the explosion in the chip demand is going to just explode. So that's kind of an interesting take on why maybe some of these have been doing well lately. But you got to figure there's going to be some crumbs falling off of NVIDIA's table. So AMD, Intel, and some others should probably take advantage of that.
Right.
But based on that, we did see some unusual option activity, probably based also on the fact that earnings is tomorrow after the close. But they went out to the October monthly series here, so it's not an earnings type setup for this trader. But they bought 20,000 of the October 27 strike calls. So these are deep
back up to VWAP.
$7. They paid $7.65 for each one of these calls. So that break even of $34.65 over the next 86 days, that's only about 1% above the current share price. So buying deep in the money calls, it's got the higher delta, it reacts more like the stock, and you don't need that big of a move to the upside, while still also giving yourself 86 days in this position. So yeah, this is unusual for sure. And there's already a big open interest position in that strike over.
Oh, there's SPY little rip above VWAP.
This adds another 20 to it. So yeah, somebody building up a big, deep in the money position on this one. Stock replacement almost.
Okay. Intel, we'll watch it. I guess it deserves a look too, like everything else. Tomorrow after the bell. Today we'll be focused on Lam Research. Texas Instruments, not great so far, so that kind of dropped the ball. Let's look at Trade Desk real fast. Been a really good winner.
Yeah.
MNK shut down there.
Yeah, they got earnings.
Look for a halt to the downside.
August, up 86 to 87% so far this year. But they're in there buying puts. And I thought this was pretty interesting because what is, this company's a digital marketing
15% on
Groupon.
Groupon.
For digital ad buyers. Their total addressable market in the digital ad space, about $135 billion. The total addressable market for advertising, $800 billion. So they can make some inroads in here, targeting digital ads. That's big business right now. And we got Meta after the close today. Recently got a downgrade to a sell out of New Street, but then Needham came right back and upped the price target to 100 recently, just yesterday. So somebody buying puts in here, probably setting up maybe.
Rallying back up a bit.
Miss here.
Closed out a little too early, I guess.
3,500. The August 80 strike puts for an average debit of 350, so that break even is 76.50 over the next 23 days. You know, not too big of a move, and the option market's pricing in a bigger move for that. But somebody's setting up for some bearish activity in trade.
JP Morgan to buy almost $2 billion in mortgages.
Well, it's
NatWest deal.
been quite a grower. So the higher they go,
Any response on that?
Fall, something like that.
Possibly.
Some,
Yeah.
So,
Yeah.
all right. Guess that's what they're betting on here. But have to have a big shock because the stock's been doing great.
Yeah.
Thanks, Tom. All right. Interesting trades here. Let's get one more stock-specific story before we do some trading in the macro world. Dan Deming will do that with us, and Jenny will give us an update on Teladoc, which is finally breaking out of a months-long grind near the lows.
Yay, Teladoc.
In a moment.
What? Biggest volume on Teladoc since April of 2022. That is neat. Yeah, I feel like there must be insiders buying this up today. I'm gonna look for some more calls. Maybe tomorrow. Yeah, even these shorter dated ones didn't move a whole lot. Guess that's just earnings. IV crush. Yeah, I mean they moved 3x, which isn't crazy for how big of a move this is when it's been so tightly wound up. $15 minutes. Wow, looks like it wants to reach for the sky. Broke out of that head and shoulders. Alright, SPY coming back down here. I don't know what calls to get on Teladoc. IV is still quite low. Which is nice, I guess. Maybe we'll get September's instead of October's. 35s instead of 40s. Maybe just 30s.
Expanding really all over the last couple of weeks, which overall I'd say is a positive for the market. Russell has been showing a relative strength here.
Oh yeah,
for
11.5.
last 3 weeks.
Yeah, we were liking cost. I was looking at it earlier today.
Today, certain names that really have underperformed year to date are coming through earnings and reacting very
No options, so it's a little bit more of a commitment.
iPaper, United Health,
Financials kind of suck.
Name a few. Today you got Chubb,
Actually,
and you
no.
got ADP, and and
Maybe getting better.
Boeing for that matter. So I think you're starting to see,
Excuse me.
I guess to some degree, the mean reversion kind of taking hold, or an expansion of the strength that we have realized in other parts of the market.
Okay. Like that point about the other parts of the market, really so important, can't be stressed enough, especially against the backdrop of the Federal Reserve talking about the economy, rebounding and maybe even seeing some growth despite their policy. So certainly encouraging. It sounds like the soft landing talk continues. Does that mean we need to start trading commodities bullish, Dan?
That's a great point, Oliver, and it's possible. We're seeing some selling pressure in WTI today, but overall, you look at the metals, hanging on to the levels here and showing continued signs of strength. When you look at gold and silver, crude coming off the recent highs, that's 3+ month highs. So backing off a little bit today is nothing, I don't think, too significant, given the fact that it has kind of broken through some key levels here and potentially challenging those highs that we did see in early April. So that would be up over the 82 level. And I think the expansion in some of the other areas, the grains have shown some renewed strength. And I guess the expectation is that if we're not going to realize a recession, and I think Chairman Powell and the FOMC kind of basically enunciated that today in their view now, that they don't see the U.S. slipping
Good
into
eye on
recession.
that cost,
So,
TJ.
yeah, you would think that would be beneficial to some of these areas, particularly commodities and other asset classes that were betting on the fact that we'd see significant slowing.
The trading gold today and Bitcoin firm in the complex of futures very broadly do kind of stand out maybe as a sign of some of that softer tone from Powell. It does generally connect with an uplift in some of the more traditional commodities too, though. I mean, which is kind of the point of the discussion, right? I mean, if we're going to get rates staying calm and the economy able to warm back up,
MNK went for it. $1.50.
That could potentially turn against us.
Ooh.
Sure. Yeah, and while the dollar coming off
$1.55
is benefiting some of those areas as well, Oliver. So yeah, the market now, based on the message delivered, you're seeing some selling pressure in the dollar. We're going to get some more clarity in the next 24 to 48 hours. ECB tomorrow morning, Bank of Japan, I think Friday morning. So those will be market movers. PCE on Friday as well will be another big market mover when you look at the data points this week. And so overall, the shifting dynamic of the expectations is really, I think, driving the markets here. And the expectations just a couple months ago were basically everybody was on board that it was going to be a recession, and how deep wasn't sure, and the expectations were rates were coming down by the end of the year, and that's just not in the cards anymore. At least that's not priced into the market at this point. And if that's the case, you're seeing the effects spreading out to different.
All right, 10 minutes of Fugazi is upon us.
The effects kind of starting to unfold when you look at the dollar relative to some of the other commodities and gold and silver. Lower rates stabilizing here is also a beneficiary type of environment. And you're seeing the commodities starting to show some signs of strength in the expectation that demand will remain fairly strong.
All right, nice, well said. Good setup for us in our Schwab panel coming up with some international central bank
for responses.
Activity.
I don't have any answers for you, Lords.
Dan, thanks very much. Managing partner, KKM Financial. Dollar down, seemingly paving the way for some commodity strength, but today it is muted. More strength in gold and Bitcoin as a little bit of a risk-on trade.
Them's up 4%.
Joining me next for the panel into the bell, we got Jeff Kleintop. And we got Colin
Can't
Martin
believe all
joining us
Teladocs
to
held
talk
up. It's just
bond
crazy.
reaction after the Fed,
Before we're down to
international
VWAP.
picture with those other
MNK,
central
there's
banks
a
on deck.
rejection.
We'll be right back.
$1.50. Wow. They start day trading shares more with these runners. I rarely have ever done that. Lars has not been banned for happy money. Everyone can see your dumb comments. Don't worry. High's coming down. He's coming down a bit. Teladoc never even hit VWAP today. Got close. Barbecue 374. I'm gonna pick up some more shares. It's so hard in the morning with volatility and just not getting filled. Yeah, I'm gonna get some more shares. Even like trying to dip buy in the morning is difficult. Show. I'll listen if I have time. I try and listen to keep up on the dockets and different tinfoil.
Tomorrow, of course, we're going to hear from the European Central Bank. The ECB will almost certainly raise rates by 25 basis points. And the market expects another 25 basis point hike in September, but the volatility could come from the fact that inflation is cooling very rapidly in Europe. In fact, Spain has already seen inflation retreat to below 2%. Spain's consistently Europe's inflation trend by about 3 months, and that suggests that Eurozone inflation may be at the 2% target by the end of Q3. And no rate hike in September. European stocks are trading, Oliver, at about 12 times earnings, well below their 10-year average. So signs that rate hikes could be coming to an end could support valuation gains for European stocks tomorrow.
Okay. So markets for stocks been kind of bouncing around. Bonds and the dollar seem to have found their conviction a little bit faster. Yields down, dollar down. Why is that, Colin?
Well, we saw a lot of volatility, as Jeff mentioned, following not just the release of the statement, but also during the press conference, where we initially saw yields fall, we saw yields rise, and then actually we saw a pretty sustained and sharp decline in Treasury yields of all maturities towards the tail end of the press conference. I think that had to do with a question and answer about lending standards and bank lending standards. And Fed Chair Powell mentioned the senior loan officer survey, and that as expected, we're likely to continue to see standards tighten a little bit. But if we look at the crux of the meeting, it was as expected, very, very few changes to the statement itself. the Fed raised rates by another 25 basis points, bringing the upper end of that range to its highest level since 2001. I think what's most important is what comes next, where the question is this a pause? Will they now hike at every other meeting, which is kind of what they did right now? And as expected, Powell basically dodged those questions and just took a step back and said, you know what, we're data dependent right now. We have a lot of data between now and the September meeting. We have 2 CPI readings. We have the ECI this week. We have a couple of labor market reports. And at the end of the day, the Federal Reserve just doesn't know if the job is done yet. So the door is open. Markets aren't necessarily pricing in additional rate hikes just yet. But if we see inflation remain stubbornly high, and Powell highlighted that, even though we're seeing headline numbers come down, core inflation readings are still near 4 to 5%. I mean, that's something to watch.
Yeah,
right
picked
now.
up some
If they
more.
don't resume that downward trend, that could result in more rate hikes than the markets are currently expecting.
Do you find truth and veracity in his notion that we can get down to 2% without any major employment disruptions? It seems like he's a little bit more confident about that right now, Colin.
You know, he seemed pretty confident, and right now we're seeing that. Of course, we can't, start celebrating just yet. The job isn't done just yet, but we're seeing
My stop, my theoretical stop or mental stop loss is a break of this low, 30 cents.
Stronger than we expected.
So pretty big
we're
range.
seeing economic growth slow down a little bit right now. If we look at the past 5
4%.
quarters, GDP's
Take
risen
profits.
just over 1%. That is below trend growth, but it's not a sustained period of
High
negative
here.
readings. Yet we're still seeing
40
a strong
cents,
labor market,
if
and we're
not sooner,
seeing,
or if
spending
not later.
remain okay right now. So that soft landing is a possibility, but I think it remains to be seen if the strong trend in underlying economic data can continue, given how high the Fed has hiked over the past 16 months or so, and given that we expect the Fed to remain at such a restrictive level for a while.
I suppose then if the non-Chinese central banks around the world are still inflation fighting, that should also work in favor of Powell's goals here, Jeff, but China the exception.
Yeah, China's the exception. I mean, just continues to try and apply more stimulus, though doing so incrementally and in different packages and here or there. All the different agencies are applying things separately. It's not one big coordinated effort, the bazooka, if you will. It's not coming out, and we're not seeing massive rate cuts either. Although they have the capacity to do that, and inflation in China is 0.0, so they certainly have the room to.
All right, 1 minute, half a minute.
But they're worried. They don't want to follow the path of other major central banks and provide too much stimulus, too much to the economy, and create an inflation problem and debt problems. And so they're being cautious about that. Though I think we'll see a bit more stimulus rolling out here in Q3 for China, but definitely the opposite of what we're seeing from many other central banks.
Okay, good perspective.
You may or may not get fired today.
Appreciate it, Colin Martin. Jeff
I don't know.
From the Schwab Center for Financial Research.
Buy ripping there into close.
About 90 seconds until the bells will come back for Meta. That's the parent of Facebook and Threads. In case you forgot, Metaverse, not really a big story for them right now.
You live to work another day. Thank you guys for the support today. Sorry the stream died. The double stream. But you guys came back swinging. 24 likes, not bad. FOMC today, Powell today. Nice little volatility. Like I said, we opened up puts here and calls here. Too far out of the money, but still ended up working out. Closed puts somewhere or close to break even after FOMC. And then closed calls like here. And then rode the futures up, closed them here. Didn't take the short down, took the long back up to like here. That was what we traded on the market. And we'll see where we go from here. We had a cup, we had a handle, retrace back up. I think we could keep grinding back up to this high still. And see if we reject, make a triple top, or if we break out of this cup and handle. Yeah, I mean, what he said was more or less hawk or dovish. So market kind of expected it. And if we break again, yeah, we've got 460s on the radar. And yeah. Let's see, BBIG, I bought in here on the double bottom, then sold out on the break of that low. I wasn't planning on day trading it, so I didn't take profits when it started rejecting the breakout. And then I realized I had day trades on that account, so I actually closed it here. We'll see on this one. We give it some time. It did come above the line here, but didn't make any sort of bullish formation. No inverse head and shoulders really. And yeah, so we'll see. That one might keep melting down. MNK went crazy today. We were watching it today. You mentioned it to Ace somewhere around here. I said you should watch this one if you want to day trade. And there you go. I wasn't really watching it because I wasn't planning on day trading it, but made big moves. Started with this engulfing candle right here on the 5-minute. And you could have just held through all that with a stop, you know, down here. Did like 100% from there. So that is neat. You know, even if you were late to the party, 123%. I mean, even if you waited till it started selling off, it's still like 100%. That was a big move. $1.50. We'll see if this has continuation or after hours moves or what. Need to save some day trades for day trading of the shares. Might as well. I'm day trading SPY dailies. Might as well day trade shares too. GME flat still hasn't decided a direction here. Waiting on that. Barbecue I bought back in today. Started scaling in. So it's made somewhat of a bullish formation. It hasn't broken out of it yet, but you do have an inverse head and shoulders here. And I just wanted to break up this trend line. That was my main deal. Could still trade flat for forever, but I think it is bottoming out here and potentially ready to start rallying back up. I guess I would be closing back out if we drop below 30 cents. So we could still see some retests of the 30-cent level, which kind of, you know, that's definitely within expectations. Profits, I guess I would probably look to 35 cents, probably the first little spot, see how we do there, and then back to 40 cents and see if we break out of those resistances. I had a cup and handle. We have another cup, and I wouldn't even say it's actually handle. Kind of retraced too far for that even be considered a handle. Just kind of making handle after handle. Slowly making higher lows though, and the highs are pretty much the same. So a breakout at some point of this, see the upside or the downside, could go either way. At this point, it looks like this is flattening. So yeah, looks pretty nice. Teladoc had the big rip. I'll probably be getting back into some Teladoc. Maybe tomorrow, maybe end of the week. Sold the calls on that today. Zoom was up some. Let's see. What was the volume today on barbecue? Was it a lot? Oh, it was low volume today. Interesting. Very interesting, actually. Maybe coming to the end of the accumulation, maybe we'll start to rally now. You can see it's been accumulating the last 4 days. Decreasing volume. Very low. Price action didn't reflect super low volume. I guess it was though. So yeah, I'm in Dish. I got Dish shares yesterday. I got some calls today on it. Let me show you guys the calls. Let's see. Bought Dish calls, sold Teladoc puts. That's what I did today. Got January 15 strike calls on Dish. And I sold those Teladoc calls. And then I told you guys what I'd done the futures. And then on the options on SPY, I showed you those too. And then yeah, just picked up a pretty good amount of barbecue shares today. Look for more as the week continues. As we continue to show support being met. And yeah, that's what I got. Barbecue cooling off. Yeah, thanks for your support though, guys. Thanks, Zumi. Appreciate it. Thanks, Christopher. Thanks, Lords. Thanks, Pulte. Mark comments, counting on that flag. 18 sharp drop cost bar flag, etc. Alright, Lords. Well, maybe. You see why I'm trading it the way I am. I've just explained it. So 18's definitely a possibility. And like I said, if we drop below that 30 cents, I will be closing out and waiting for the next setup. But at this point, I see it starting to set up. So I think we could get a huge dip on some docket dropping, as we've seen, which might be a good opportunity to dip buy. Even if it says we're fully liquidated as shareholders, apparently. But we'll see. Thanks, Christopher. Thanks, guys. Appreciate it. Sub up, like up, comment down. Happy money sticks around. And thank you, Ace, for your gifted memberships today. I appreciate it. Let's see, we got 5 new members there, I think. Yeah, a couple from the earlier one. Thanks, guys. Have a good night. We'll see you on Discord. See you on Twitter.